Alrighty. So welcome to the only Iron Condor trading course you'll ever need, where you get to master the Iron Condor in the next 4 hours, even if you're a beginner. So for this trading course, I've compiled the very best Iron Condor trainings that I've ever created, and I've organized it in a very structured way where you get to literally learn everything you need to know about Iron Condor in just this one video. So if you've been thinking of, buying courses on Iron Condors, then guess what? There's no need for you to do that because you get everything inside this video. So let me just very quickly go through exactly what you will learn inside this Iron Condor trading course. So I've broken it down into a number of chapters. So chapter number 1 is on what is the Iron Condor. Chapter 2, why trade the Iron Condor. Chapter 3, you get a deeper look into trading the expected move. And this is a very important concept that you really need to get right if you plan to trade the Iron Condor well. And chapter 4, you also get to learn the top 3 Iron Condor mistakes that you should be avoiding, right? So these are the mistakes that quite a number of beginners make at the start. And chapter number 5, let's talk about stop loss on Iron Condors, whether it's helpful or harmful. Now, chapter 6, we get into choosing the right strike price specifically for Iron Condors. Chapter 7, I'll give you a trade construction walkthrough where I show you exactly how to construct it on the option chain so you can do it for yourself. Now, chapter 8, I also give you a variation of the Iron Condor that's called the Jade Iron Condor. So this Jade Iron Condor has a much higher win rate, which is about 85% win rate. Now, chapter 9, I also give you the best underlyings to trade the Iron Condors on, especially if you're just starting out, right? If you're new to trading options. And chapter 10, this is where we get into the details of how to manage losing Iron Condor. So you will face losers sooner or later, especially if you trade long enough. And this is where you really need to know how to manage it properly. And chapter 11, we'll talk about when and how to roll the Iron Condor. Chapter 12, we'll talk about what to do if you get assigned on your Iron Condor. So this is the proper way to unwind any assignments, so you never have to worry about assignment again. Chapter 13, a very important chapter. This is where we get into the scenario planning, where we map out all the different scenarios that can happen after you get into an Iron Condor trade and what you should do. And then chapter 14, we'll get into the Iron Condor frequently asked questions. This is where I took on some questions from my subscribers, and then I answer it in a presentation. And finally, chapter 15, I will give you your Iron Condor trading plan for success. So if you're ready, let's dive right in. What is the Iron Condor? If you're not familiar with the Iron Condor, well, it is actually just a defined risk strategy with the combination of a put credit spread, which is also what is known as the bull put spread, plus the call credit spread, which is also known as the bear call spread, right? So as you can see down here, this is the P&L graph for the Iron Condor. So basically on the left hand side, you have the put credit spread, right? This is also what you call the bull put spread. And on the right hand side, you have the construct of a call credit spread, which is the bear call spread. So if you're familiar with trading credit spreads already, then it's just a combination of both of them, right? You join them both together and you have what you call the Iron Condor. So if you were to take a look at this chart down here, then you will notice that the strikes are on the opposite side of each other. What it's trying to do is to try and capture profits if the market stays within a range, right? So as you can see down here, the profit range is pretty big, right? So most of the time when we trade the Iron Condor, right, it's pretty much also considered trading the expected move, right? So if you're not familiar with the term expected move, I already talked about it in another video, which is the number 1 secret for being consistently profitable to trade the options, right? So for this Iron Condor, basically it's trading the expected move and it's trying to capture the profits in within this range. And from what we already know, right, most of the time the market will stay within this expected range, right, more often than it does not. The very first reason is that this is a defined risk strategy. That means to say the max risk has been kept, right? As you can see down here, there is the long options already bought down here on both sides, right? If you do not have these long options, so what it becomes is just 2 naked options. This is what you call the strangle. But because you have these 2 long options, let me just remove the drawings here. Because you have these 2 long options, so what it does is that it caps the max risk. So if for some reason the market just shoots all the way to the moon, right? Or maybe it crashes all the way to zero. Well, guess what? You cannot lose more than what you have already defined the risk at the start for the iron condor, right? So that is why this is considered relatively safe and very good for you if you're just starting out, right? So this way, you won't let any single trade take you out of the game. Now, reason number 2 is that it has a decently high win rate, right? So if you can see in this graph down here, you can see that the win rate is 68.26%. So this is the typical win rate. So this is roughly around 16 to 20 deltas, okay, on both sides, so on both short strikes. So this is the normal typical profit probability or profit for a iron condor. All right, so for the iron condor, although it says it, the typical range is about 65 to 68%, generally we actually can have a higher win rate because, as we already know, as I talked about it many times in other videos as well, that IV most of the time is often overstated compared to the RV, right? IV means the implied volatility, RV means the realized volatility, right? In layman terms, what it means is that the expected range, or rather the range that is being, forecasted by this implied volatility, is usually much bigger than where the market actually moves. So most of the time, it actually stays within the range. That is why you have a higher win rate. So as you can see down here, this is a study done by the Tasty Trade team, right? This is on a 20 delta $5 white iron condor, right? So if you were to think about it, delta is also used as a rough estimation for the probability of it being in the money, right? So for example, if you have on one side, let's say for example, this is the short put. Let's say for example, this is a 20 delta. So what it also means, right? It has an estimate that there is a 20% chance that the market will actually close below this short put at expiration, all right? So again, this is just an estimate, right? The real probability, you will have to take a look at the column, all right, called probability of being in the money, right? But it's pretty close, right? It's off by maybe 1 or 2%, right? So imagine if you have on both sides, you have 20 delta, which means to say on both sides, there is a 20% chance of either being in the money on both sides. So what does it leave in the middle, right? You have 20% on the top side, you have 20% on the bottom side, which means to say it should be 60% of the time, the market actually stays within this range down here, within the short call and the short put strikes. But instead, if you notice, we are actually getting more than this 60% based on a 20 delta $5 white iron condor. So this supports the fact that the IV often overstates the realized volatility. So that is why you actually tend to get a higher win rate than what is theoretically suggested, right, based on the P&L graph. So remember, when we are trading the iron condor, the main reason why we want to trade it is because we want to generate an income. So if you want to generate an income, you definitely want to have something, that is pretty often that you can win, right? You want it to be consistent win as well. So that is why with the iron condor, you have a win rate of pretty high, right? I would say average around 70%. So that is why this is also a good reason why I think this is a good income strategy for beginners. But now, reason number 3 is that you do not have to pick a direction, right? So one of the hardest thing for many people when they first start trading options is, which direction should they pick, right? They're not sure whether should they be bullish, should they be bearish, is the market going up, is the market going down? So the best way, if you're not sure, then all you have to do is just trade the expected move, right? Basically, all you're going to say is that I have no idea is the market going down, I have no idea if the market is going up, but I do know that the market will move in the next don't know how many days, right? Based on the expiration date of the options. And you know that it will stay within a certain range, right? More often than it does not, right? So all you have to do is put on the iron condor, and that's why you get the probability of win of somewhere around 65% and above, right? And it's a good way to trade the expected move and takes advantage of the fact that the realized volatility is less than the IV, which is what I talked about. And again, this is the studies done by the Tasty Trade team. They've done a lot of research into this as well. And as you can see, based on this index ETF, which is the spiders, the average realized move you can see it's much lesser than the average expected move, right? As you can see, in fact, for all different volatility levels, even if it's a low volatility environment or a very high volatility environment, right? In both cases, the IV, which is depicted by the expected move, right, is greater than the actual movement in the market, right, which is depicted by the realized volatility, right? So the realized volatility is less than the IV. Now, this is not just for the spiders, it's also for the other index ETFs like the IWM and the QQQ. So that is why the index ETFs are a very, very good vehicle for you to trade this Iron Condor. So let's get into reason number 4, and that is that it is very versatile, right? So what I mean by versatile? Versatile means that you can actually construct it based on your outlook of the market, right? It can be neutral, right? So as you can see, it is pretty equidistant, right? Almost equidistant, right? Because sometimes, or rather all the time, when you trade on index ETFs, they tend to have put skews, which means to say, right, the put, if you were to both use 20 deltas, let's say we're going to use 20 deltas as example, then you'll notice that the 20 deltas, okay, this should be a triangle, not a zero, all right? So you'll notice that for the put side, it will be lower than the call side, right? So maybe the distance from where the market price is to the put, right? Just as an example, maybe this would be 30 points, whereas from here to here is maybe, let's say, 25 points, right? That is because that is the put skew. Now, it's also very versatile because it could also be a bullish Iron Condor, which means to say you think that the market might actually go up, right? But then you also want a little bit of a hedge in case you're wrong, right? So the typical way that people would actually, you know, put on a trade when it comes to a bullish outlook, right, is they will actually put a bull put spread, right? So let's say, for example, you do not have this call spread down here. This would just be the bull put spread, right? You just put this bull put spread down here for their bullish view. Now, there's one problem with this idea, or rather this strategy with the bull put spread, and that is, what if you're wrong, right? Because if you're wrong, what happens is that you will take the full hit of this loss, which you've already defined in the starting place, right? So that's fine. But if you have this call spread along with it, making it into an Iron Condor, right? Let me just remove the drawings here. So now you have both sides. So even though if the market goes down here, what you lose here, at least you will make a little bit based on this credit spread, right? Because when you sell this call spread down here, you're also getting a premium for it. So this is slightly better, I feel, compared to if you were to just put on the bull put spread. Now, of course, if you have a very, very bullish view, you think the market is going to go up, then of course you can just put on the bull put spread. Now, if you're more bearish, then guess what? You can shift it down as well, right? So if you notice, this is the neutral. If I want it to be bullish, I just shift the whole thing up. If I want it to be bearish, I shift it down. So as you can see, I shift the Iron Condor down, and you cannot see the long strike down here. In fact, it has gone so far down below this that you cannot even see it, right? So there is a long put below, which I didn't put down here because, you know, it's out of the screen. So basically, if you are bearish right now, then guess what? This put spread down here also serves as a hedge to your call spread down here, because in case if you're wrong, the market shoots through, at least you still have this put spread down here. So that is why I would prefer that you actually use the Iron Condor, the bullish or the bearish one, rather than just, you know, going alone with the, you know, the call credit spread or the put credit spread. Because if you also think about it, you actually get more credit, because now you get an additional credit with the other side. So that's how you reduce your overall risk as well. Okay, now reason number 5, and that is that it is profitable over the long run. So again, as you can see down here, this is a test done by the Tasty Trade team. So this is the cumulative performance of a 20 delta $10 wide Iron Condor, right? So basically the wings are $10 wide, the deltas are 20. And as you can see down here, they show two different graph results, right? This is if you were to exit your trade at 21 DTE, and this is if you were to exit at expiration. So in both cases, they are actually profitable, right? Just that the 21 DT is more profitable compared to if you hold to expiration, all right? So this is one thing you want to take note of. What exactly is the expected move? All right, so the expected move is basically the amount that a stock is expected to either go up or down from its current price, right, in by a certain time based on its current level of implied volatility. All right, so basically it's how much a stock can move, right, based on the days to expiration left. So basically when we are trading options, you can see that there are these numbers down here which is telling you when these options will expire, right? So based on the implied volatility, it's going to tell you roughly the expected move that the stock will make either up or down, right? So if you are a mathematician, you really like to take a look at the formula, you can see this is the formula, right? I'm not going to go in depth into it, right? Because the good news is that there's really no need for you to calculate this yourself, right? There are trading platforms that actually show this to you already. So all you have to do is just get the numbers from your trading platform, right? For example, this is TD Ameritrade. Think of Swim platform. You can see that when you pull up your option chain on the right hand side, you will get to see these numbers, right? So the percentage wise is basically the implied volatility, all right? And on the right hand side of it is basically the move in terms of the dollar move based on this implied volatility. So you can see this number down here says plus 16, plus or minus 16. That means it will go up or down 16 points, all right? So it's plus 16 on the top and then minus 16 below. So basically this is what the expected move is. So why is this very important? Right, so this is important because when you're using expected move, it allows you to devise a strategy around this, right? If you know roughly the range that a stock will move at any given moment, let's say for example, if you think that the market could go from this range to this range, all right, let's say for example, the stock price right now is this, all right? So this is my attempt at drawing a candlestick, right? So at this point of time, this is where the range could be based on the implied volatility. Now, historical statistics have shown that the implied volatility usually overstates the actual volatility. That means that prices tend to stay within the expected move more than the probability suggests. So for example, if the implied volatility says that the range should be somewhere from this point to this point, well, the actual volatility, right, actually could be much narrower. That means it could actually only move from this point to this point. Now this is actually important because when we are trading the expected move, right, you can put on strategies that just trade in this range, right? So I shared in my previous video market neutral strategies. That means that you actually do not have to pick a direction in order for you to make money from markets, right? So the traditional way of trading is that if you want to make money when the market goes up, right, you normally just buy it, right? So in hopes the market goes up. If it goes up, you make money. If it goes down, you lose money. And if you short the market, right, let's say for example, you just sell the shares. If it goes down, you make money. If it goes up, you lose money. But when it comes to trading the expected move, you actually do not really have to pick a direction. You just have to say that, hey, I think that the market is going to stay within this range in the next number of days, which you have chosen based on the days to expiration. And then if it stays there by expiration, you're going to make money. All right, so here's the cool part about this. So probability suggests, right, based on the expected move formula, right, they have all this calculation. It states that the probability should be 68%. That means that it will stay within this range 68% of the time, right? From this point all the way to this point, the probability is 68%. But the actual occurrences within this range tends to be higher. And if you can see, this is a study done by the Tasty Trade team. Let's just take a look at this expected move formula on this left hand side. So basically, what it's trying to say that the actual occurrences is actually 85% instead of 68%. That means it actually stays longer in this range more than what the probability suggests. That means you actually make money more of the time. So let's say, for example, you receive a premium of, let's say, $2.50, which is $250 for trading this range. And let's say, for example, you put on a strangle, all right, or an iron condor, all right, let's say you get $2.50. That means to say, if the market stays within this range by expiration, you're going to receive the full credit of $2.50. Now, by probability, right, from this calculations which they have made, it states that you will only make this $2.50 68% of the time. But in actual fact, you do not just make 68% of the time, you actually make 85% of the time. And then 15% of the times, it will be losers, right? So that means now you have your expectancy skewed towards your advantage. Right now, you have a higher than usual way or usual rate that you're going to make money. So that is why in the long run, you're always going to have a positive expectancy because this number is actually skewed in your favor, right? So this is the studies which is done by Tasty Trade, and they even went even further to find out how this actually works in ETFs, right? Index ETFs. So if you were to take a look at this table down here, you can see that on the left hand side it says the average realized move. That means this is the move that the market actually made, right? The average expected move is based on the implied volatility. That means before the move has been made, they came up with the formula based on the expected move, and they say that it most likely could move around $16.57, right, in this range. But instead of actually moving $16.57, the actual realized move is much lesser than that, and that's $10.81. And they even broke it down, right? So they broke it down, as you can see down here, they broke it down by the IV rank. So you can see that when there is low volatility, the expected move is actually also higher than the average realized move. And even when it's times when there is very high volatility, and high volatility normally is when there are market crashes, right? The market moves a lot. You can see that the expected move, right, far surpasses the average realized move. So you can see that actually in all instances, regardless of what the implied volatility rank is, right, the expected move is always more than the realized move. So this is for SPY. Right, you can see it's the same as well for the other index ETFs which we have done the studies on. You can see for IWM as well, the expected move is higher than the realized move in all instances, right? It's all higher. Again, they did it for this QQQ as well. So you can see QQQ as well. QQQ tends to be much more volatile than the other two index ETFs, and even with this index ETF, you can see that the expected move is much more than the realized moves. Alright, now the thing is that this implied volatility do not overstate the actual volatility in all time frames, or rather in all expiration dates. So you can see that they also did a further study to see when the expected move actually is bigger than the realized move. So you can see this is a study that they did since 1993, and this is about 30 years worth of research, right? So this is pretty statistically significant because there is a lot of data points that they have taken from, and you can see that the time where the expected move actually exceeds the actual realized move is from the 45 days mark onwards. But anything before that, you can see that it actually does not exceed, right? It's only 45 days from the 45 days marks that it exceeds. What does this mean? It means that when you want to trade the expected move, and you expect it to stay within this range, then you want to choose the days to expiration that is 45 days and greater. Now, if you were to take a look at the longer days, you can see if it comes to 60 days and 90 days, the discrepancy is even bigger. You can see that from here, the expected move is 7.9%, but the realized move is actually 6.5%. So there's a 1.4% difference. Down here, there's a 0.5% difference, and if you take a look at 90 days, there is a 2% difference. So what does this mean? So it seems as though that it becomes a little bit much more unpredictable, the kind of move that the stock or the market will make as the time frames gets longer. So it's almost as though they want to overcompensate for the move because they're not sure, right? So in a sense, it's something like, I'd rather have a larger margin of safety, then if I make it smaller and then if I get hit and then I'm wrong, right? So they rather make it bigger in a sense whereby the implied volatility, they overstate it by much more than the actual realized move that is made, so that in the long term there's much more room for error. But if you would see that in the shorter term, it's pretty accurate, right? So this is pretty efficient. You can see that the expected move kind of matched the realized move, and in fact, in this 4 time frames, the realized move is more than the expected move. But as it gets longer, that's where you can see the difference is, right? The expected move is much more than the realized move. So that is why when we come to trade our trades, our options, we want to choose for somewhere from 45 days to 60 days. For me, the sweet spot is from 45 days to 60 days, because anything that is longer than 60 days, 2 things happen, right? Number one, basically the theta decay is not as high, right? The theta decay is not really as accelerated as compared to when it's slightly closer to the expiration date. So that is why I do not want to typically go above 60 days. And number two, you notice that the premium that you get kinds of dropped off, right? So for example, if 30 days, right, let's say for example 30 days you're able to get, let's say, $2 in terms of premium. Now if you were to take this by simple math, if you were to go to 60 days, this should give you, let's say, $4 in premium, right? Because you're just simply doubling it. But instead, you do not get $4. But instead, what you get, maybe you only get, let's say, $2.80, right? So you can see you get much lesser. And if you get to 90 days, the kind of premium which you get per day becomes even lesser. So if you were to take just simple math, 30 days times 3, it should give you $6, right? Because you just times 3, because it's just 3 times of 30 days. But instead of $6, maybe you only get $3.30, right? So as you can see, the premium which you get per day really drops off as the number of days increases. So that is why the sweet spot is usually around 45 to 60 days, where you get a good decent amount of premium. At the same time, you also get a good decent amount of theta decay. And at the same time, you will see that the expected move is greater than the realized move. So that means that if you were to trade the expected move within the 45 to 60 days to expiration date, more often than the 68% suggests, right, you will be profitable. Alright, so this is all theoretical. So how does it actually plays out, right, when you actually start trading it? So what I did is I actually put on a year's worth of trades where I trade the expected move, and then I'm going to show you the results, and we'll take a look together to see whether is it true that, you know, it's more than 68%, right, more than the probability suggests, where it says, where it's supposed to be 5%, or whether do I actually only hit 68%, or is it lower? Alright, so there are a number of different option strategies that you can use to trade the expected move. So for this, what I did is I traded the strangles. Alright, so basically it doesn't matter where the market goes, as long as it stays within the expected range, then you are able to profit, right? So if you're not sure what the strangle is basically just a short call and a short put combined together. All right, so let's, for example, you just take a look at this price down here. So what you want to do is you sell a call above, and then you want to sell a put below as well. So basically where you place the strikes is where the expected move is. So what I've done down here is I've shared with you the last 100 trades which I put on in terms of the strangle. So as you can see down here, there are winners and losses, and you can see that overall these are the stats, right? I try to squeeze everything into this table down here, but as you can see, it's just a little bit too big, right? So I just gave the essential details down here. So you can see down here the win rate is 77%, which is very consistent with the fact that the win rate is always higher than the theoretical 68%. Right, so the loss rate is only 23%, and you can see down here the average win is $269, and the average loss is negative $203, right, which is very good, right? You have the biggest win is 785, and the biggest loss is minus $449. So as you can see down here, while there are losses and there are losing streaks, you can see down here is a losing streak, about 6 losses. Overall, this is still in a profit, right? So you can see down here, I've calculated out the expectancy, right, which is $160.44, which means on average, when I put on this trade over the long run, you know, I expect to make about $160 per trade on average.
So these are the top 3 mistakes that you want to avoid when you start trading the Iron Condor, right? So mistake number 1, and this is a very common mistake that I see many people make, especially I do see a lot of YouTube creators as well. They actually have been advocating having very tight wings, right? Having very small width for your Iron Condor. So basically, I have down here 2 Iron Condors as a comparison. So you can see down here on the left hand side, we have a $2 white Iron Condor, and down here is a $10 white Iron Condor. So what it just means is that the wings, right, for this is $10 white, okay, and which is for both sides, and for this is only $2 white, okay. So now at first glance, you can see, right, tell me, what do you think, or which do you think is the more riskier trade? Well, at first glance, of course, a lot of people will just say the more riskier trade would be this, the $10 white iron condor, right? Because your max loss is $750, whereas for this $2 white, your max loss is only $125. So you actually lose much lesser than the $10 white iron condor, right? So that's why a lot of people say, all right, go for the $2 one. It's much safer, right? You kept your risk and you do not lose that much. But that's one thing that they are forgetting, right? There's one thing that is missing down here. Because don't forget, when you enter your trade, each time when you enter your trade, you will always have to take into account your risk per trade, right? Your risk per trade, which is the dollar amount that you're going to risk every single trade. So let's say, for example, you have a pretty decent sized capital, and for each trade, when you allocate capital to each trade, let's say the max risk you can allocate to that trade is $750, right? Let's just say your maximum risk based on your capital allocation, the most you can risk per trade is $750. So you could either go for one $10 white iron condor, or if you go for the $2 white iron condor, let me ask you, would you just put on one $2 white iron condor? Of course not, right? Because based on proper capital allocation, you want to size up your trades so that each trade will be equal to, the risk per trade that you are actually putting on for the trade, right? So in this case, you wouldn't actually just put on one $2 white iron condor. Instead, you would have to put on 6 $2 white iron condor. So this way, your max risk right now is the same. It's at $750, which is the risk per trade which you have already decided on to allocate to every trade that you put on, right? So right now, for this $2 white iron condor, you have a max risk of $750. For the $10 white, you also have a max risk of $750. So right now, we are kind of speaking apples to apples, oranges to oranges, right? So now, if you take a look at this, which do you think is actually more risky, right? If you think about it, and if you think about this rationally and you see it, right, it's actually much more riskier for this $2 white iron condor. But why? Because the market, if the market goes all the way up this way and it stops here, right, at 205, let's say it stops at 205 is where it settles, let's say, the expiration. For your $2 white iron condor, how much are you going to lose? Guess what? You are going to lose the full amount of $750, right? Because your max loss is all the way at this point. Anything past this blue line down here, you're going to lose the max loss. But what about the $10 white iron condor? Well, the $10 white iron condor, you actually do not have the max loss because the max loss has to be past all the way here, right? Past this blue line over here. But as of this moment, it has not. It's somewhere in the middle. So for the $10 white iron condor, most likely you will only lose about 50% of the max risk, right? Whereas for the $2 white iron condor, you're going to lose everything that you have risked for this trade. So as you can see down here, the reason why many people mistake that the $2 white iron condor having tight wings is less riskier is because they just think that per trade, or rather per contract, is less risk. But you notice, as you can see down here, you have to allocate capital. So down here, clearly, it's so much easier for this $2 white iron condor to lose money because the market does not have to move much to hit the max loss compared to the $10 white iron condor. As you can see, it is so much difference, right? From this point where the $2 white iron condor hit its max loss compared to the $10 white iron condor where it hits its max loss, right? It's about $7.50 wide. Okay, so that's why, as you can see, this is a mistake that many people make. Mistake number 2, and that is having a stop loss. So I actually have a number of people that have emailed me, they are asking me some of the strategies that I've shared, and they say, Davis, what if we implement a stop loss? Will this actually help reduce the risk and help increase the performance? Well, the Tasty Trade team as well, they have already came up with this study, right? So they went to test whether having a stop loss is actually effective. Right, so for this, they tested it on the Strangle, which is actually pretty close to the Iron Condor because the Iron Condor is just the defined risk version, right? The Strangle, they do not have this long call, they don't have this short put, this long put, but pretty much it's about the same. So as you can see down here, they tested 2 different management. First one is to just hold to expiration. The second one is to have a stop loss. And if you notice, the one with the stop loss, right, that's 2x whatever your credit is, I think. So basically, if your credit is $1, then they will have a stop loss where if it reaches, your credit becomes $3, right? Because remember, we are selling credit, we are option sellers. So if we sell at $1, we ideally want the price to go down. We want it to go to $0. That's the best case scenario. That means we will earn this full $1, right? But if the spread is actually losing money, it will actually go up in price, right? Because now you are selling at $1, you're buying back at a higher price. That's why you're losing money. So this 2x basically is just 2x the premium that you have sold it for in terms of your loss. So your profit will be $100 per contract and will be lost 200. So this is how they are testing it. So as you can see, in the long term, managing losers or having a stop loss is actually not that effective. You might as well just hold it to expiration and you have a better chance of getting a better result. All right, so mistake number 3 is holding to expiration. All right, so why is this a mistake? Well, as you can see down here, if you were to exit your trade at 21 DTE, you can see that your performance is actually much more superior, right? At the end of the day, you get a higher daily P&L. So if you were to take a look at the graph as well, which you have seen earlier, you can see that the performance is so big of a difference, right? You can see that exiting at 21 DTE, you actually have a much better result compared if you hold to expiration. So that is why, it will be better if you want to exit at 21 DTE rather than hold your trade to expiration, because if you hold your trade to expiration, you also have another risk, and that is the risk of early assignment. Right? If your short strikes are in the money, let's say the market is somewhere down here, and there's 2 days left to go, there's a very good chance that you're going to be exercised here, right? If you're going to get exercised, you're going to be assigned on a short call, then guess what? You're going to be short 100 shares per contract. On the other hand, if you're going to be exercised on this short put, then guess what? Per contract, you're going to be long 100 shares. And if you're going to long 100 shares or short 100 shares on an index ETF, then good luck to you, my friend, because you are going to be in for a margin call, right? The broker is going to call you up and say, send them more money, all right? So if you want to avoid this situation, then you definitely want to exit at 21 DTE, which is much safer, which reduces your risk of early assignment as well. So as you can see down here, here's another study done by the Tasty Trade team. This is if you were to hold to expiration, right? If you hold to expiration, you notice that the chances of you actually hitting your max loss is higher, right? So this is the delta wing. So delta wing is the long option on both sides. So they tested between 13, 10, and 5 deltas for the long options on both sides. So as you can see, if you hold to expiration, the chances of you actually reaching the max loss is pretty high, right? 13 deltas, that means it's closer to the short call. You have a 6.4 chance all the way to 1.2% chance. But if you were to exit at 21 DTE, look at this, right? Something magical happens. All of a sudden, the chances of you hitting your max loss has dropped to 0.4%. And if you have a 5 delta long option, right, on the both sides, then guess what? It becomes 0%, right? This is from the index ETF, by the way. So as you can see, if you want to actually trade the Iron Condor, it's much better for you to exit at 21 DT rather than hold to expiration.
So if you come from the traditional world of outright stock trading, buy, sell shares, then you would be very used to having a stop loss, because having a stop loss is important to manage your risk and not have any single trade blow up your account. But what about when it comes to trading options? Does it make sense to have a stop loss? And does stop loss actually work the same way as it would, right, in options as in outright trading, right? So for this, we want to lean on data research and all the studies that I've already done to make a more informed decision, right? The last thing we want is to pull out the idea, out of the thin air, or let's just pull it out of our ass, and think that we are right. Like anything in life, when we are making any decisions, whether you realize it or not, sometimes you are really already relying on statistics, right? On data, right? Let's say, for example, whenever you buy any food, sometimes you will turn around to the packaging and you want to see, what are the ingredients, or whether, there are any harmful stuff inside there, right? Like, for example, trans fat, right? Trans fat, many years ago, we have no idea what that is. But as more studies come out, we found out that trans fat actually, increases health risks in our body, right? Like, for example, it increases the risk of having a heart attack or stroke. So that is why, when it comes to buying food, we want to try and avoid
eating, any food that has trans fat, because the data, the research, the statistics have already proven that it's bad for our health, right, in the long term. So when it comes to trading options, it's the same way as well. We want to lean on the data research to make an informed decision rather than, just believe that our own thinking is right. So this is where you want to unlearn everything that you have already learned from the traditional world of, outright trading, buy, sell stocks, and then now just open up your mind and take a look at some research which is specifically regarding options. So this is the long-term performance of the Strangle. So this is a study again by the Tasty Trade team, and they have done many research and studies on this. And what they did is they compared managing losers to holding to expiration. And what they found is that holding to expiration actually gives a better result, a better return than managing losers, right? So as you can see down here, the managing losers is 2x. What it just means is 2 times the credit which you receive, right? So for example, if you sold this Strangle for $1 and then you buy it back for $3, what happens now is your losses, okay, this is a 3, so your losses will be $2, okay? So this is a dollar sign, pardon my drawing. So what it means is that per contract, the max profit that you can make on this would be $100 because that's the credit you receive. And because of your stop loss at 2x, your losses will be $200, okay? So this is how they measure these studies down here. This is how they do their studies. Now, this is for the Strangle. You might be asking, Davis, what about the other strategies, right? So again, this is for the short put, right? This is for the 16 delta short put. And again, as you can see down here, holding to expiration is much more effective, right? The results are better than if you were to have a stop loss. So again, this stop loss, I believe, is at 2x as well. Now, while at the earlier stages, right, let's say right after the crash, somewhere around 2009, going into 2010, right, managing losers might have a better result, right? But this is pretty short-lived, right? Because in a number of years' time, you can see overall, holding to expiration is just going to outperform, having stop losses. So yes, stop losses, you're still going to be profitable, but hey, if you already just held to expiration, you would be even more profitable. So in this case, there's no point for you to actually have a stop loss. Now, you might be thinking to yourself, hey, Davis, this is undefined risk, right? Undefined risk. What about defined risk strategies like credit spreads and iron condors? And I'm glad you asked, because here are the studies, right? So this is for credit spreads. So I believe this is the put spread. So again, they have tested, the $5 wide put spread and the $10 wide put spread. And as you can see, holding to expiration again has better performance than, if you were to cut your losers at 2x the premium which you receive. Same thing for $10 wide spread. Again, holding to expiration is much better than cutting losses, right? Having a stop loss. Now, what about iron condor? And again, iron condor is the same as well. If you hold all the way to expiration, you can see your results are still much better than, whatever multiple losses that you plan to cut off at. You can see they have 1x all the way to 5x. That means if you sell at $1, for this 1x loser, you're cutting off at $2. And 5x losers, basically you're cutting off at $6. And in all instances, holding to expiration is still much better than if you were to have stop losses, right? So as you can see, this is a very common theme amongst all the different strategies. So we can really just see from here, the data has already shown, the statistics have already proven to us that over the long term, holding to expiration will already have a better result than if you were to actively manage it and then have stop losses. So if stop losses are not as effective in managing risk, and we don't want to hold to expiration, mainly because, we do not want to have the risk of early assignment and then possibly having to face a margin call, what can we do to manage risk more effectively and get better results? So if you have already seen a number of my videos or you've been a follower of my channel for quite some time, then you probably already know what I'm about to say, right? And the answer, in terms of managing risk in trading options, exiting at 21 DTE is much more effective than having a stop loss. And again, I'm not just pulling this out of the thin air. I want to lean on research, data, statistics, right? There's a reason why I say exit at 21 DTE is much better, because there is evidence to support this.
So again, as you can see down here, this is the statistics, the data, research, study, whatever you want to call it, has been already done. And this is on the strangle. As you can see, we already know that holding to expiration is going to be far more effective than having a stop loss, right? The results are going to be better. But if you were to exit at 21 DTE, guess what? Your results are going to be even better than holding to expiration, which means to say it's going to be even far better than if you have a stop loss. All right. Now, this is for the strangle. What about for the other strategies? Well, this is for the naked put, all right, the short put, the 16 delta put. So as you can see, exiting at 21 DTE, again, better than holding to expiration. For credit spread, same thing as well, right? 21 DTE is still better than if you were to hold to expiration. And again, that means far better than having a stop loss. And again, for Iron Condors, same thing as well. If you were to exit at 21 DTE, you're going to have a much better result than holding to expiration. So there is another table I want to show you, which is far more interesting as to why this is so, right? Because it's very puzzling. Why is it that holding to 21 DTE and even holding to expiration is even better than if you will have a stop loss, right? Because this is something a lot of new traders just cannot grasp. Why is this so? So if you were to take a look at this table down here, it actually shows some very, very interesting data, right? Some interesting research that they have shown. So down here, you can see these are the number of losers where you cut off, right? Basically where you employ your stop loss. And this tells you, how many losers you would have incurred based on cutting off at, the various multiples, right? Based on your stop loss. And this is the number of losers you would incur if you actually exit at 21 DTE. Or earlier than 21 DTE. So you can see that if you were to cut off at 1x the credit which you receive, you're going to have 28 losers. But if you were to exit at 21 DTE, right, maybe even earlier, you only have 12 losers. And if you go to, 2x your losers, then you would have 14 number of losers. But when it comes to 21 DTE or earlier, you actually have 4 losers. And as you can see, it goes all the way to the extreme. If it goes to 5x, you notice that you actually have 2 losers. But when it comes to exiting at 21 DTE, 4x and 5x losers, actually there isn't any at all. Which means to say, if you were to exit at 21 DTE, you actually do not sustain that big of a loss compared to if you would have stop losses. So this table down here is even more interesting because they went into even more details, right? They went in depth to find out how many of those losers actually became a winner, right, by closing at 21 DTE or earlier. So if you were to exit at 1x the credit which you receive, you can see that you have 12 losers. But if you were to exit at 21 DTE, 11 of those losers that you close out actually came back and become a winner, right? They actually became a profit. And if you were to cut off at 2x and 3x, you can see that at 2x and 3x, you will have losers, right? 4 losers for 2x, 1 loser for 3x. But then if you were to exit at 21 DTE or earlier, then guess what? All those trades actually eventually came back and became a winner, right? So this again is very, very puzzling for a lot of new traders. And I'm going to explain why this is so, why some of these trades actually came back to become a winner. And it's not necessarily because the market actually bounced back, although that could be one of the reasons. But another of the reason is something that options have and outright trading don't. Right, and I'm going to share this with you. So why is having a stop loss on options ineffective? Well, the main reason is because options have a mechanism that outright trading don't, and that is theta decay. Theta decay just means that over time, the position, right, if it doesn't move, it can become more profitable, right? Because as you can see down here, this is the purple line. This purple line down here shows you your P&L graph at the point when you first put on the trade, right? So this is a put spread. And the green line down here is where it's at expiration. Now, over time, this purple line will start to move towards this green line and becomes this green line at expiration. Which means to say, let's say, for example, if the market actually trades down here, and then you tell yourself, hey, it has already hit my stop loss of, let's say, $50, I'm going to get out of this position. Well, you may have gotten out a little prematurely because if the market didn't move, and time just went by, then guess what? This position is actually going to become profitable. Now, there's another way where a lot of new traders use stop losses, and that is when it actually hits their short strike down here, right? So this will be your short strike of the put spread, -1 put.
This is where the long strike is, +1 put, right? So this is where you have your bull put spread. So many traders, new traders that is, they want to employ the stop loss at where the short put is. That means if the market was to trade down here, this is where they are going to cut their losses. But this is actually not very effective when it comes to options, and this is the reason why. One thing down here you need to look at is the probability of touch. So the probability of touch is a statistic that will let us know, what's the percentage of it actually touching that strike price at any time before expiration, right? So for example, if you have a 30 delta short put for your put spread, it just means you have roughly 70% win rate, right? So this is at expiration. So you have a 70% win rate on your put spread, which is actually pretty good, right? This is what many traders want to strive for. They want to have a pretty high win rate when it comes to having a put spread. So 30 deltas, I would say, is pretty good. A good mix of premium as well as, win rate. Now, 30 deltas also mean another thing, right? It also means that it has a 30% chance of being in the money at expiration. But more importantly, when it comes to stop losses, you want to use probability of touch, which it means to say that it has a 60% chance of being touched, being breached at any time before expiration, right? So if you decide to exit your position whenever your short strike gets breached, then guess what? 60% of the time, you will be stopped out, right? So whenever the price drops down here, you're going to cut your loss. Most part of it is likely going to be a loss because 60% of the time you're going to cut your losses. So that is why having a stop loss on options is not going to be that effective compared to if you were to trade outright trading. So based on all these statistics, research, and data that we've already seen, we can conclude that having stop losses is actually not as effective when it comes to options trading, and it's much better to just exit at 21 DTE. Now, inevitably, whenever I show, any of this data, research, and studies that have, pretty strong conclusion that stop losses is not effective, there will always still be some people that will reach out to me and then tell me, something like, hey, Davis, what if I'm still not convinced that stop losses are ineffective for trading options, and I still think that stop losses will help reduce my risk when trading options? I still think that stop losses is going to get me better results because I've used it in outright trading, and I think that it's going to work in options trading as well. So I'm not convinced that, the data that you've just shown me, the studies that you have just shown me is actually true, right? Maybe because you're using stop losses differently, right? You might say that, hey, I use stop losses differently, right? I don't cut off at a multiple, I cut off in terms of a dollar amount, right? Let's say maybe at $50, I want to cut off the position, or at $100, I want to cut it off. Or maybe you say that your stop losses is based on technical analysis, right? I cut off my positions, when it breaches the stop loss or when it breaches the resistance, right? If you're one of those guys in this camp where you're saying this, then here's my answer to you. So if despite all the studies and research that I've already shown you that shows that stop losses are no better than holding to expiration, and in fact exiting at 21 DTE will yield you a better result compared to holding to expiration or even using stop loss, and you still want to use stop losses because you think you have a different idea on it, then guess what? Go ahead, right? Just go ahead. I mean, after all, this is your money, this is your life. Why do you want to let a bunch of PhDs who does options quantitative analysis for a living and also trade themselves, right? So they practice what they preach. Why should you let them tell you what you should or shouldn't do with your own money? After all, it is your money, right? So you should bear the responsibility of what should happen to your funds, if you choose to trade it the way that you want to. So if you really still want to use stop losses, and on a more serious note, then you definitely want to test out your ideas over 100 plus trades and then compare it to exiting at 21 DTE and then see if your results are actually better, right? There's no point talking or commenting on my YouTube channel, say, hey Davis, what if I just put a stop loss at $50 loss? What if I place a stop loss when when the support is broken? Well, instead of just telling me all this and just pulling out the idea out of thin air, actually test it out, right? Test it out, but of course do this on a demo account instead of a live account, right? Because if you actually found out that your stop losses, your usage of stop losses actually is going to be better, then you actually do want to go ahead and use stop losses instead of, exiting at 21 DTE based on all the research that I've shown you down here. And if your results actually prove that the Tasty Trade research team's analysis, right, all the studies that they have done are wrong, or maybe they have missed out on certain part of the studies on stop losses, whereby, you have found an effective way to put on stop losses that is better than 21 DTE, then please let me know. I really love to know about this, because I would even create a video on this, right? But until then, until you have actually found out a way to prove that stop losses is actually better for the rest of us, please just lean onto the data and research that's already been shown, already been done for us. All right. So at the end of the day, I've already shown you all this data, studies, research. Do stop losses on options actually help or harm your trading performance? You've seen all the research, all the data, all the studies. Now you decide for yourself. So the selection of Iron Condor strike prices can be broken down into two parts. Now the first part is in selecting the short legs, and then the second part is in selecting the long legs, which basically define the wings of the Iron Condor. All right, so let us get into the short legs first. So how do you decide what strike price to choose for the short legs? So for this, there are two methods. So the first method is by price level, right? So that means you are going to choose the specific strike price based on the price level. So for this, you want to first identify the support levels that's below the current price. So as you can see down here, this is where the current price is. So you want to identify the support levels that is below where the current price is. So as you can see down here, I've already drawn two lines below. All right, down here. And then you also want to find the resistance levels that is above the current price. So in this case, you can see I've drawn two resistance level down here. So the whole idea down here is that you want to choose the strikes that is beyond this support and resistance levels, right? You want to choose the strike price that is above the resistance levels, and the put side, you want to choose the strike that is below the support level. So in this case, let's say for example, if the market starts to move, at least there is a good chance, or a rather higher probability, that the market could bounce back up. And on the upside as well, let's say for example, if the market goes up, then at least there's some chance, because there's a resistance level, that the market can come down. All right, so that is why we want to choose our strikes that is beyond the support and resistance levels. Now you notice that there is actually another resistance level up here. Now the thing is that you could also go for a strike price that is above this resistance level. So this way, there are two resistance levels, right? This is the first resistance level, and this is the second resistance level. So this way, it makes it a little bit harder for the price to, get past these levels. And the whole idea is that for the Iron Condor, we want it to stay within our short strikes as much as possible, right? Between our short legs. But the thing is that, let's say for example, you want to place this short strike down here for the short call side above this price. But what you notice is that if you go to the option chain and you see that the premium for this short call is going to be so little and it's very, very far out of the money, then there's no point for you to put on this one, right? So instead, you do not want to go for that one, right? So we don't go for this, and you go for the other one, right? So at least this one is nearer to where the current market price is, then you at least have some sort of premium. So this is a balance that you need to kind of strike, right? So if at certain points, let's say for example, you found the strikes that is beyond this support and resistance levels, but the problem is that you may not be getting as much premium as you like to, then you may have to wait, right? Maybe you have to wait for the market to go travel towards, closer towards either of the support resistance level. Then from here, there is another support level. Then you can start to place, your short call and your short put beyond these two levels, right? So this is where you really need to take a look at the option chain at that point in time before you decide to put on the strikes. Now, the second method is using the expected move. So this is the preferred choice for myself. So what is the expected move? So in layman terms, the expected move is the theoretical calculated range that the underlying is expected to be in by a certain time. So let's say, for example, you want to know, this underlying down here, what is the likely price it will be at in the next 60 days. All right, so let's say 60 days. So you can see down here, this box that I've drawn down here just depicts the expected range, right? Roughly where it might be in the next 60 days. So there is a whole mathematical formula that is used to calculate this, right? So they are able to kind of have a theory as to where the price could be at in the next 60 days, right? So this is what you call the expected move. Now, next, you need to understand the difference between the expected move and the realized move. So the realized move is the actual move that the underlying makes, right? So basically, the expected move is what the calculation is trying to predict, and the realized move is the actual move in the market itself. Right, so as you can see down here, more often than not, the realized move is smaller than the expected move, right? So the green color down here, I've already drawn this box down here to show you this is the realized move, whereas the orange box is the expected move. So as you can see, most of the time, the realized move is actually going to be smaller than the expected move. So what does this mean? So this means that if you choose the strike price at the expected move, you will win more often than not. So how do I know this is true? Well, there is a whole study already done by the Tasty Trade team, right? So the Tasty Trade research team, they have done quite a bit of studies on this to measure the average expected move against the average realized move. And as you can see down here, this is a study on SPY. So they have even broken it down to the different volatility levels, right? You have volatility levels from 0 to 20, 20 to 40, all the way to 75 plus. So as you can see, in all the different volatility levels, the expected move is always greater than the realized move, right? So this is for SPY. And by the way, this is a pretty significant study set because it is across numerous years, right? I think they have a study set for over a decade or so. So this is for IWM. Again, as you can see, it's the same. The average realized move is lesser than the average expected move. And for the QQQ as well, the average realized move is also lesser than the average expected move. So when you choose the strike prices based on the expected move, you will be able to be profitable. You'll be able to have the prices of the underlying stay within this zone more often than it doesn't. Now, you might be wondering, so how do I choose the strike prices based on the expected move? So there are two ways. So the first way is using the expected move formula. By the way, there's no need for you to calculate by yourself, which I'm going to show you later. And the second way is by using the 16 delta option. So this is the theoretical expected occurrences within the range, right? So basically, this is the orange color box down here, right? So the theory suggests that the prices of the underlying would be staying within this range 68% of the time. But I want you to take a look at this, right? So this down here says the actual occurrences within this range, which means to say this is the realized move. So as you can see, it is much greater than 68%, right? Anywhere from 71% to 85%. So these are the two ways that you can use to calculate the expected move and choose your strike prices. Now, one thing I want to point out is that 16 delta options usually is wider than the expected move, right? So this percentage down here, you notice that the percentage for the 16 delta move is only 71%, whereas the expected move formula shows 85%, right? But if you were to go to the option chain, you will notice that the expected move is actually has a smaller range compared to if you place your strikes at 16 deltas. So I think the stats down here have been switched, all right? I think there was a kind of a mix-up down here because the 16 delta options, right, is wider than the actual expected move depicted by the formula. So I think the stats down here that you see on the 16 delta options belongs to the expected move formula, and the stats for the expected move formula belongs to the 16 delta options, which means to say if you choose the 16 delta options, the chances of the price staying within that zone is going to be far greater than if you choose the strike prices based on the expected move, right? So you might be wondering, how do you choose, the prices, the strike price based on the expected move? So you do not actually have to calculate this yourself, because if you were to open up your option chain, you actually already see it at the right-hand corner, right? At the top right-hand corner. So you can see down here, there's this number plus minus 18.03. So basically this is the range, right? You take where the current price is. So let's say the current price right now is 184.36. All you have to do is add 18 points to the top, All right, and then you have to minus 18 point at the bottom, and that will give you the expected range. Now, of course, this is not drawn to scale, but you get the point, right? So this is for the expected move formula. Now, the other way is by using the 16 delta. So you need to go and find the column that says delta, right? So down here, it would say delta, and then you will be able to see all the different delta for the strike prices. So this is for the put side. So as you can see down here, I already have a position at the 16 delta mark, right? At the 16 delta strike price. So as you can see, I practice what I preach. Now on the call side as well, you also want to choose the 16 delta, right? So that is how you can choose the strike prices based on the expected move. So now that we have already chosen the short legs, the next step is how do you decide what strike price to choose for the long legs, right? And again, there are two methods for this. So the very first method is by using a fixed width. So for example, maybe you have a $1 wide iron condor, and you also have a $3 wide iron condor or a $5 wide iron condor. Then from there, you will basically just increase the contract sizes based on your risk per trade. So let's just say, for example, on this $1 wide wing iron condor, maybe you get, I don't know, 35 cents. All right, this is a dollar sign. Maybe you get 35 cents in terms of credit, and the max risk for this will then be 65 cents, right? So if you are trading one contract, it means to say your credit you're going to receive is $35 and your max risk is going to be $65. So what many people will do is that they will actually increase their contract size based on this, right? So let's say, for example, you can risk $650 per trade. All right, let's say you have decided that the max risk you can take on per trade is $650. Now, because one contract based on a $1 wide iron condor, your max risk is $65. So how many contracts can you trade to make up this $650 in terms of the risk? Well, the answer would be 10 contracts, right? So this is what a lot of people do, right? They basically just put on many contracts and have a very tight wing iron condor. Now, I'm not a big fan of this, and I've mentioned this in many other videos as well. And the main reason is that it's actually much easier for your max loss to be hit, right? Because the market, it doesn't have to move much just to hit your max loss, right? As you can see, it's only $1 away from where you put your short strike. So if the market just goes below your long strike, at this point, let's say it settles at 177, at expiration, then guess what? You're going to lose everything that you risk down here, right? But if you put on a wider one, let's say, for example, you put a wider one, $5 wide wing, then if, let's say, for example, the market goes to 177, then at expiration, you're actually not going to lose as much as compared to, you know, putting on the $1 wide wing. So that is why I don't really like this kind of a method to just, you know, have a fixed width and then just keep increasing your contract. So my preferred method is actually method number 2, and that is to expand your width to fit your allocated risk per trade. So what do I mean? So let's say, for example, if you have $500 to risk per trade, then you first want to start off with a 5-point wide wing and then work your way to reach your allocated risk per trade. Okay, so let's say, for example, this is the iron condor that you put on, and this is a $5 wide wing on both sides, right? So they are equidistant. So at this point of time, you take a look at your trade and you notice that your credit is $1.20 and your risk is $3.80, which means to say your max risk is $380 per contract. So right now, because your max risk that you have decided on this trade can be up to $500, you actually still have some room for you to expand this iron condor wing. So what do I mean by expanding this iron condor wing? So what you want to do is basically just adjust the long strike by another strike, right? You just widen it out by another strike. So from here, you notice that I've widened it by just 1 point, right? From here, it was 197. Then you stretch it out to 198. And on the other side, the put side, same thing as well. You stretch it 1 point away. So now it becomes 174. So if you take a look at the credit right now, maybe it would say $1.60 and your risk is $440, right? $4.40, basically one contract is $440. And again, you still have some room to reach the $500. So what do you do next? Again, you expand your wings, right? So you widen out your wings even further. And now you have a 7-point wide wing. So now you take a look at your credit is $2, and now your risk is $5, which means to say one contract is $500, and that means you have already hit this risk per trade that you want to put on for this trade. Now, if you compare this, which one do you think is much riskier, right? So let me just remove this drawing. So let's say, for example, both right now could be already risking $500, right? Let's just assume the fact that this person down here maybe put on many contracts. All right, let's just say, for example, you have 8 contracts on down here, and the max risk is also $500. Okay, so in terms of the max risk, by the way, this is a dollar sign. Let me just draw this properly. So the max risk right now is $500. Both they are the same. All right, so I show you again the other one. This one, the max risk is going to be $500. But now I want you to take a look at which one do you think is going to hit the max loss sooner, right? Let's say, for example, the market went down, and then at expiration date, right, all else being equal, that means both have the same expiration date. Let's say the price settles at $177 at expiration. So in this $1 wide iron condor, how much do you lose? Well, you lose the whole $500 amount, right? Because the max loss that you have kept is up to this wing, the one that you have bought back. This is where you have kept your max risk, and anything that goes past that will basically be hitting your max loss. So you already have hit your max loss of $500 for this trade. Now let's take a look at the other one. Now for this, because the wing is much wider, so let's say again the market now settles at 177 at expiration. What is your loss? Now your loss is definitely not going to be $500, because your max loss will only be hit if the market goes past this long put strike down here, right? So most likely for this one, you will only lose maybe half of it, right? Because it's somewhere in the middle of your this put spread on this side, right? So as you can see, the $1 wide wing is much riskier. So if it's much riskier, why do many people actually want to go with this $1 wide spread? Well, the first reason is probably they think that it's safer to have a smaller wing. But again, this is very relative to the risk per trade, right? They don't realize that by actually tightening their wing, making it so tight, it's actually riskier, right? The second thing is that you actually get much more premium. Your premiums will start to gradually taper off as you expand this wing, right? As you stretch this out. So many people, when they put on the iron condor or any trade for that matter, what they only like to look at is the kind of credit that they get. So yes, you may get a higher credit, but then again, you're putting yourself at a much higher risk as well. So at the end of the day, which one should you choose? It really comes down to you, because if you are the one that prioritize, I want to make as much money as possible, I want to get as much credit as possible, and you are not too concerned that, you might hit the max loss on the particular iron condor trade, then you could go for this one, right? You go for a very tight wing, and then you increase your contract size. At the same time, you also incur more commissions. But if you are more prioritizing your risk, that means you want to make sure that you do not lose so much each time, but you also stand a very good chance to be in profit. Then you want to go for this one, because one other thing that I forgot to mention is that the win rate, the probability of profit, is actually higher when you expand your wings compared to if you have a very tight iron condor with just $1 wide. So I hope that in this way, you really now understand why it's actually better to expand your wings when you actually much more to risk, rather than stick to a $1 wide wing iron condor and just increase your contract. Now, of course, if you only have, let's say, $70 to risk on a single trade, you do not have much more than that, then of course you have no choice but to go with only a $1 wide wing. Now, it's only when you can start to increase the contract, instead of considering to increase the contract, you increase your wings.
All right, so we are at the Thinkorswim platform. So let's take a look at how you would construct the iron condor on Amazon, right? So the first thing you want to do is to look at your calendar month, right? So is there 45 days left? So this is 42, around there, so this is pretty good. So next thing you want to do is to choose your short strikes. So to choose your short strikes, again, there are two ways. You can either look at the delta. So this is the delta. You can look for the 16 delta on this side and also the 16 delta on this side, or you can use the expected move formula, right down here. So all you have to do is just take out your trusty calculator. So we're going to take out our calculator, and then we want to see what's the current price. So the current price is 129. Let me just round it up to 130 to make it easy. And then we want to minus off the expected move for the downside to see what's our short put strike. So this is around 14.8. Let's run it off to 15 points. So it's roughly 115. So we want the 115 short strike on the put side, and let's take a look at the call side. So the call side, again, you take 130 and you add 15. So you're going to have 145. So our strikes is going to be 145 and 115. So what you want to do is you right click and you click analyze sell trade, and you go down to Iron Condor. So you can see it's going to populate your strikes. So the short strikes for the put option has already been settled, right? So 115, 110, $5 white wings, perfect. Now we want to go over to the call side. So what we want is 145, right? So 145, we want to change this to 145. So we go all the way down to 145, and then we want to have the wings $5 white. So that is $150. Right, so as you can see, we are collecting $1.42. So that's roughly close to 150, almost 30% of the width of our Condor, Iron Condor, which is $5 white. So this is the first way you can construct your Iron Condor. Now the next way is to take a look at the delta. So if you take a look at delta, you want to find one that is the closest to 16 delta. So let's compare both of them and see what's the difference, right, on the risk profile. So let me just pull this up. Right, so we want to go somewhere around 15 to 20 deltas. Now if you were to go to the lesser delta, now you're going to receive lesser premium for this. And let's say 16 delta down here. Let's just try and construct one and see how it looks like. So it says 147.25. Now I don't want to go for this kind of a weird strikes, because it's going to be very odd, right? It's going to be very hard for you to find $5 white later on of this. So I'd rather just go for the rounded strikes, the well-rounded strikes, which is multiple of 5 points. So the closest will be around 20 deltas. So 15, 25 deltas, I'll go for 145. So as you can see, it's the same. Right, let's say if we go for the 16 delta strikes, see what can we go. So I'll go down. So this is what I'll take a look at. So the next one I'll go is 150. So that's a multiple of 5. Now this is too far away. This is 13 deltas. Right, 13 deltas is a little bit too far away. You're not going to collect enough premium. So I won't go for that. So it's going to stick to 145 on the call side. And what about on the short put side? On short put side, the closest is going to be 18 deltas. So there you go, right? So there actually isn't any change by using the deltas compared to using this expected move. So we're going to stick with this, and we're going to stay with this and take a look at the risk profile. All right, so this is the risk profile. Now on this box down here, you can see this is where you can adjust the dates to take a look at the P&L graph at any given point in time. So let's go to today. So as you can see down here, this is where the P&L graph looks like today. Right, this is how it looks like. So if I was to use this lines down here to mark the break-even point, you can take a look at our probability of profit. As you can see, it's right on mark, 68%. So this is one standard deviation. Right, at the same time, you take a look at the box at the background. You can see this shaded gray box at the background. This shows the one standard deviation range. Right, you can see it's slightly to the right hand side, right, but it's pretty much the same. Right, so the market theoretically is going to stay within this range between 68% of the time. Now, as we have seen in the statistics already, we know that it's going to stay actually longer than 68%. I mean, rather, it's going to stay more often in this range than 68%. Right? So from here on, what you want to do is take a look at the different P&L curve, right, at a different date. So remember, the studies which I've showed you, it shows that you want to take it off at 21 DTE. So let's go all the way to 21 DTE. As we can see that the expiration date is on the 21st of October. So when there's 21 days to expiration ref, that's around 30th, right, or maybe even the 1st. So on the 1st of October, you can see this is where your curve will look like right now. So as you can see, it becomes steeper. So it becomes even more steeper. Alright, just take a look at this curve, this slope down here. You can see that it will become steeper as days go by. You can see it becomes steeper and steeper. You can see that? That's because of the effect of gamma. So that is why the theory comes, or rather the studies have shown that if you take off at 21 DTE, you're going to have a lesser volatile P&L. Right, so here's how you might want to manage it. So basically for me, what I want to do is that I will wait until there's 21 days left. So let's go to the 1st of October. So when there's 21 days left, let's say for example it stays anywhere in within this range. Now there's two things you can do. Either you can just tick it off down here and then put on a new iron condor, or you could wait for it to reach the 50% mark, because in the end it's still inside this profit zone, right? So how long will it take to get to the 50% mark? So we have already collected 142 upfront for the premium, so roughly half of that will be $70, right? So if the market was to go all the way to where it was when we first put it on, you will have your 50%. But you can see that as days go by, right, it will go closer and closer towards this expiration risk profile. So that means that anywhere from this point down here, you can see that this purple line, you can see it says the P&L at this point in time. So now 50% profit will be somewhere here, 70 to 70. So you can shift this all the way here, all the way to somewhere here. All right, so that means any time in point in time, if the market just shift into this zone, right, it may be here and then it moves inside this zone, you're gonna just take profit, right? So this is if you take off at 50%. Now if at 21 DTE, let's go back to here again, if you see that it's currently at a loss right down here, it's at $48 loss. Again, two things you can do. You can take off for the loss, play for the statistics which I've shown you just now, and then just put on a new trade, or you can just hold on to see whether it actually profits, because you notice that there is positive theta that's working for you down here, because as each days go past, you can see that anywhere that is from the break-even zone, in within this break-even zone, your P&L curve is actually going to gravitate closer and closer upwards, right? That means you're actually going to get make profits, right? So if you were to take a look at this P&L down here, it says on the left hand side you're losing $48, around 48, all right, $47. Now you see what happens if I increase the days. You see, as the days go by, you're losing lesser and lesser and lesser, right? So this is in the event, let's say the market doesn't move at all. So as days go past, right, the theta is going to work in your favor. It's going to keep pushing you up the profitability until to the point that you can even reach the profit zone up here. So you could choose to manage it that when it reaches 21 DTE and it's still within this profit zone, you're still going to hold on to it, right, until it finally exceeds this break-even point. So that means once it goes past this break-even point, starting from 113.58 and below, now this is where I will consider taking it off, because right now you are outside the profit zone, which means to say, as you are outside the profit zone, let's say if you are at this point down here, this is where your theta flips over and becomes negative. That means that as days go by, you're losing more and more money. So if you take a look at the P&L down here, you see at this point in time, you're losing 118. Now as days go by, you can see this 118 starts to increase the loss. Your loss starts to become bigger and bigger and bigger, and eventually it starts to match the expiration risk profile, where you could even lose $358, which is the max loss at expiration. So that is why if you want to hold on to this trade past the 21 DTE, it will be better if it's only within this profit zone. Only when it exceeds, right, this profit zone area on both sides, then you can choose to take it off. And if you take it off, it's also for a slight loss, right? It's not going to be for a huge loss. It's not going to be for the max loss. But if it comes back, right, or it stays within this zone over the next few days, or always closer to expiration date, then you have a chance at higher profitability.
Now, the Jade Iron Condor is basically just the defined risk version of the Jade Lizard, right? So the Jade Lizard is actually a short put, where you have just the short put down here. So I'll put the short put over here to let you know this is the short put strike. And then you have the bear call spread on this side, right? So I'll put BCS. So as you can see, the bear call spread is this side. Now, for the Jade Iron Condor, it's actually an iron condor structure, because this is actually also a put spread. So you can see down here, all right, maybe you can't really see down here. I'll just put an arrow over here. This is where your long put is, right? So basically what it is a put spread on the left hand side. This is where you get your put spread, right? Your bull put spread. And then on the right hand side, you have your bear call spread. So this is basically the same structure as an iron condor. Now, the only difference, you will notice is that on the right hand side, this bear call spread over here, you notice that the spread is actually pretty small, right? It's very tight, right? It's much narrower than this put spread on the left hand side. And the reason we want to structure it in this way is so that there is no risk to the upside, okay? So basically, the Jade Iron Condor is a way for you to put on the Iron Condor so that, you know, you do not get hit on the upside. So the market, if you notice, this is where the current market price is, all right? This is the current market price. And if the market was to go all the way up to the moon, all right, on the right-hand side is where the prices increase. If it goes past your short strike, you actually don't really have to worry because there is no risk to the upside, right? It can go all the way to the moon and you still do not lose money on this trade because if you can see it down here, right, this risk graph down here, you can see that it is above the zero line. Now, one thing to take note is that although there is no risk to the upside, that means you do not actually lose money if the market blows past your bear call spread on the upside. You still have to bear in mind that these strikes are actually still in the money. That means you have a short call strike down here. This is the short call strike. You have the short call down here. Basically, it will now be in the money. So that is why, although there's no risk to the upside, we still do not want to hold this all the way to expiration. Now, of course, there's the argument that, you know, if the price stays within this two short strikes, right, then you can still hold on to expiration. There are people who say that, you know, even in an Iron Condor, if it doesn't breaches the short strike, they want to hold to expiration. Yep, that's fine if you want to as well. But if this goes past your short strike down here, and there's, you know, not many days left to expiration, this is where you could get an early assignment. So if you're an early assigned on a short call, what will happen is that you will become short 100 shares per contract there, right? So this is where you want to really take note of this, right? So as much as possible, we want to close out before the expiration of this whole trade down here. By the way, one more thing I want to mention is, you know, is Jade Iron Condor actually a real name? No, it's not, right? It's not something that people has adopted. In fact, I think I'm the only one that I've adopted this as Jade Iron Condor. And the only reason is because there is a strategy called the Jade Lizard, right? The Jade Lizard is coined by the folks at Tasty Trade. So basically, the Jade Iron Condor, right, I just took after the name Jade Lizard so that, you know, we all know when you put on the Iron Condor, there's no risk to the upside. Otherwise, this would actually just be called a skewed Iron Condor, right? A skewed Iron Condor is basically whereby the wings are uneven, right? On one side, you maybe have 10 points wide. The other side, maybe you have 5 points wide. This is what you call a skewed Iron Condor where the wings are not even. So when I use the term Jade Iron Condor, it just means that it's an Iron Condor with no risk to the upside. So maybe in future videos, if I just say the Jade Iron Condor, then you will know, oh, okay, Davis is putting on an Iron Condor that has no risk to the upside. So for our purposes only, and hopefully if this video gets out to many people, or maybe you guys can spread the word, let's make Jade Iron Condor an actual term in the options community. All right, now, so how do you actually structure this Jade Iron Condor? Okay, so the Jade Iron Condor, one thing you need to take note of is that the bull put spread has a wider width than the bear call spread all the time, right? On the left hand side, you notice that the width is much bigger down here, right? Let me just draw the arrow down here. So the width is much wider compared to this, where you can see this is very narrow, okay? And in terms of the delta, generally on the put side, right, we want somewhere around 15 to 25 deltas. And then on the call spread side, this is where you're going to have anywhere from 25 to 35 delta. So the thing is that you really want to go to the option chain to really play around with the strikes, because you really need to get the strikes right in order to make sure that there is no risk to the upside. Okay, if you're going to have a width that is too big, then there could be some risk to the upside. So this is where you really need to know how to change the strike. So the other thing I wanted to point out, which I forgot to point out in the first slide, right, is this thing down here. You'll notice that this Iron Condor has a win rate of 85.21%. Now, this is a pretty high win rate for an Iron Condor, because an Iron Condor, right, typically the win rate will be somewhere around 65%, right? 60, 70% if you go for the very low delta short strikes, right? But otherwise, generally, it will be around 65% or so, right? Maybe even 60%. But for this, you notice you have a very high win rate. And the only reason is because on the right-hand side, anywhere that it goes past down here from where the current market price is all a profit, right? So that is why there's this very wide win rate. Now, the trade-off, of course, is that you will get a lower premium compared to the normal iron condor. So why is this so? Well, you can see on the chart down here, or rather this P&L graph, is pretty obvious, right? Because on the left-hand side, you get the premium for a very wide spread, right? Let's say, for example, this is a $10 wide spread, right? So your premium will definitely be higher. But whereas on the right-hand side, this could be maybe $1 or maybe even $2 wide spread. So if this is a $2 wide spread, then you're not going to get that much credit. So most of the time, you will notice that the credit which you get on the put side is much more than the credit you get on the call side, right? So when you combine this together, you get a premium that is most definitely lower than the normal iron condor which you put on, because both sides would generally be of the same width, all right? Now, how do you decide the width of the bear call spread? So this width down here, how do you know how much, or rather how wide the width should be, right? So the way you want to structure this is based on what is the total credit that you can get, right? So the general rule of thumb is if you want no risk to the upside, the total credit which you receive has to be more than or equal to the width of the bear call spread. All right, so here's an example. So let's say, for example, on the put side, let's say, for example, you get maybe $1 in terms of your premium. All right, so for the put spread, you get $1 premium. But on the call side, maybe let's say you get only 35 cents. Okay, so what is the total premium down here? So the total premium, if you add these two together, it becomes $1.35. That means this is the total premium which you will receive for combining these two spreads together. So based on this, how do you know what is the spread you should have? So the spread should be smaller than this premium which you receive, which means to say if this is $1.35, that means the spread down here, it needs to be $1 wide. Why? Because the loss that you make on the call side is essentially just the spread width, right? So if it's a $1 wide width, if the market blows through this call spread on the right hand side, basically you'll be losing $1 for this spread, right? So per contract, it will be $100. Okay, so if you have $1.35 and then you have $1 loss on the right hand side, the width, if the market goes past this call spread, which means to say the net, right? Let's just put down here the net becomes a positive 35 cents, right? Which means to say if the market goes past this bear call spread, all the strikes on the right hand side, right, it goes past down here, the maximum that you can make is 35 cents, which is $35 per contract that you put on, right? So as you can see, there is no risk to the upside. Now, what happens if you put, let's say, a $2 wide spread? So let's say if you put a $2 wide spread, so now suddenly there will be risk to the upside, right? So now let's cancel this 35 cents. So $1.35, you minus off your $2 loss. So this will give you a 65 cents loss, right? So it's 65 cents loss to the upside, which is actually not too bad as well, because on the left hand side, you'll be roughly taking, about close to $800 to $900 risk, right? But on the right hand side, you're only taking about $65 risk. So if you widen out the spread on the right hand side, you could at least get more credit, because the wider the width, you get more credit and it contributes to your overall premium, right? But then you may have to take some risk to the upside, right? So this is a trade-off. So generally, if you do not want any risk to the upside, you just want to ensure that this premium down here is much more than the spread that you create down here, all right? So that's quite a bit of a drawings down here. Let me just remove all of them to make it clearer again. Okay, so let's give another example. So let's say, for example, down here, the put spread down here, let's say you get $1.50, right? Let's say if you get $1.50 for the put spread down here, and on the right hand side, let's say you are able to get, say, 60 cents. Now, if you combine these two together, by the way, when you put on this spread, let's say you put on a $2 wide spread. Let's say you put on a $2 wide spread, you get a 60 cents credit on the right hand side. So this in total will give you $2.10, which means to say there's no risk to the upside. Again, $2.10 covers the width of your bear call spread. Now let's say you want to try and push the envelope a little bit, and now you go to $3 wide. Now with $3 wide, you notice that this premium will also increase as well, right? So maybe this will now become, let's say, $1. Let's say you get $1 when you increase to $3. So now your total premium is $2.50. So now from here, you have a decision to make, right? Because immediately from this total premium, if you minus off this width down here, you're going to get a risk of 50 cents to the upside, right? $50. So down here, you have two options that you have to make a decision is whether you want to take on this small little risk so you get more premium overall for this whole trade, or you want to have no risk to the upside and then you want to go for the $2 white instead. So if you go for the $2 white, so now your premium will just drop by a bit, right? It will just drop to the previous one. Okay, so there's no right or wrong. It all comes down to what you're comfortable with. Okay, so I've already covered this, right? So here's another important thing that you want to take note of when you are creating the Jade Iron Condor is that ideally we want the call spread premium on the right hand side down here to be at least 25 to 30% of this total premium down here. All right, this total premium over here. And the reason is because if you're going to build your Jade Iron Condor and your bear call spread on the right hand side, if it's only like 5% of the total premium, then it defeats the whole purpose of you putting on this bear call spread in the first place, right? Because if the market really goes up, if the market really goes all the way up, then this put spread is going to be making a lot of money. But then you're going to cancel off your profits, right, from here because of your bear call spread on the right hand side. And for what? For only 5% of the premium, you remove all the profits that you could have taken from the put spread. So that is why we want to have at least a 25 to 30% of this total premium. So for example, if the total premium, all right, let me just remove this. So let's say, for example, the total premium that you receive for this spread is $2. So which means to say of this $2, the call spread side, you want it to be at about 50 cents to 60 cents, right? So this way it will then be about 25 to 30%. At the same time, because if you have more premium down here, if the market actually goes down, then you have some sort of a cushion as well, right? This put spread will not take the full hit because you got quite a bit of a premium that you receive for selling the bear call spread. So in a sense, it's hedging each other. Okay, so let us take a look at how it looks like on the chart, right? So if you would take a look on the chart, it will look something like this. So for this example, I've used it on the IWM. I use this on a $15 wide spread. So this is $15 wide, and you can see on the call side, this is $2. Now, where is the profit zone? So generally for a normal Iron Condor, the profit zone would actually be from this line to this line. All right, generally with this line, not including the break even. If you include the break even, you'll be somewhere around here past the short strikes for a normal Iron Condor. Okay, this is generally because anything that goes past your break even on both sides, the Iron Condor will actually start to lose money. Okay, but for the Jade Iron Condor, you actually have a wider profit zone, and if I were to color code it, you can see that the profit is basically anywhere from the short put strike down here all the way up, right? Because there's no risk to the upside. If the market continues to shoot past the roof, right, then you can still make money. And on the downside, it's basically the same as a normal Iron Condor, right? The normal Iron Condor is that if the market goes past your long put strike, you cannot lose more than that because you already kept the max risk. So when do you actually put on the Jade Iron Condor? So basically, the Jade Iron Condor and the normal Iron Condor, you can put on whenever you think that the market is going sideways or in a very neutral way, right? But I've got quite a number of people that have actually reached out to me, say that they have tried the Iron Condor, but then the market keeps going up, right? It get hit and tested on the call side. And one thing to understand is that this is actually very common during a bull market, right? You'll be tested on the call side. So this is all part and parcel of trading. But if you're not comfortable with the risk on the call side as the market keeps going up, if you think there's going to be a positive drift, just like what the index ETFs actually have, they have positive drift over the long term, it will keep going up. You don't want your call spread to be tested, then you want to put on the Jade Iron Condor. The very first thing I want to share with you is why we want to actually choose index ETFs instead of individual stocks when we're trading the Iron Condor. And this is pretty important, right? So I'm going to share with you a number of reasons why. And the very first reason is that index ETFs tend to be less volatile than individual stocks. And this is a very, very important difference between index ETFs and stocks, because for Iron Condors,
what we want is for the underlying to actually stay within our profit zone, right? So if we have an iron condor, we have a call spread at the top. All right, if you're not very familiar with what the iron condor is, it's basically just a bear call spread plus a bull put spread. All right, so at the bottom down here, you have your put spread, right? Some people call it the put credit spread. And then at the top, you have your call credit spread, right? So when these two combine, you actually have the iron condor. So your profit zone is somewhere in the middle, right? So if you want to be profitable in this trade or for putting on the iron condor, then you want the price to actually stay within this profit zone down here, right? So this is the profit zone. So as much as possible, when we're choosing an underlying, we do not want the underlying to move too much, right? We don't want it to move far to, to test either our call spread or to our put side as much as possible. So in this case, you can see in this graph down here, this is a study done by the Tasty Trade team, right? They compared the ETFs versus the stocks in terms of their movement, right? So as you can see, in the one shaded in blue, you can see that the index ETF, right, the movement is actually much more muted, right? It stays more within the zone compared to individual stocks, right? As you can see, stocks down here, you see the standard deviation move is actually much bigger, right? So let me just put the word stocks down here, and up there is ETF. So if you were to compare this two, which do you think is much more suitable for us to use when we are trading the iron condor, where we want the underlying to actually stay in within, the zone, doesn't move that much? Well, then obviously it's going to be the ETFs, right? So that is the first and one of the most important reason why when we are choosing, underlyings to trade for iron condors, we prefer to go for index ETFs than individual stocks. Now, the next reason why we want to choose index ETFs is because index ETFs aren't as sensitive to earnings compared to individual stocks, right? So as you can see down here, this is of Apple. Let me just give you an example of Apple. So Apple on this day, as you can see, it has gapped down pretty considerably, right? So this is when it released its earnings. So a lot of time when the earnings come out, the stock can gap up or down pretty strongly, right? So if you were to trade the iron condor here, this is definitely not an ideal situation for you. Now let's compare to the index ETF, right? So this index ETF is the XLK. So XLK is the Spiders Technology Sector Index ETF. And what you'll notice is that the movement on the very same day is actually so much different compared to Apple stock. Now you might be wondering, what is XLK, right? So XLK actually holds a number of tech stocks, and one of the biggest holdings is actually Apple. So as you can see down here, this shows the top 10 holdings of XLK, right? This index ETF, and Apple is at number 2, right? At 21.84%. So this is a pretty significant, a percentage of this whole ETF, because it's like the top 2, and you can see everything else below that is about 5% and odd, right? So even though this actually holds, quite a big percentage of this index ETF, the movement is actually not that big, right? You can see that Apple gaps down, but then for XLK, the movement seems as though it's like any other ordinary day. So that is one of the reasons why we also want to choose index ETFs, because we are not really bothered by earnings. So if you have an iron condor on Apple, you have to be worried about the earnings release date. But whereas when you trade the index ETF, you don't have to bother, right? If you see a setup that, you think is good for the iron condor, you can just put it on, right? So this is the second reason why we're choosing index ETFs as opposed to individual stocks. Now, the third reason is that index ETFs actually have a wider selection of strikes, right? So if you were to compare individual stocks, so for example, for this, I used the example of CRM because I had a subscriber that actually told me that they had an iron condor on CRM, and it has really went way past, one of their short strikes, right? It went so far way past that they are probably at the max loss right now. So if you were to take a look at this option chain down here, what you will notice is that first thing, there's only 5-point wide strike differences, right? If you were to take a look at the money strikes, there's 250, and the next one is 255 on the top, and the one at the bottom is 245. So that's 5-point wide. On top of that, if you take a look at the delta, you notice that the delta is not that near to each other. It's quite far apart, right? You have a 15 delta, the next one is 20 delta, then 27 delta. So they are about like 5 to 7 deltas apart, right? On the call side, it's even more dramatic, right? You can see that
there's a 10-point difference from 255 to 260, and then 8 points different, or rather 8 delta difference from 260 to 265. So why does this pose a problem? Well, this poses a problem because when we are constructing the Iron Condor, delta actually plays a very big part in our construction, right? So most of the time, let's say, for example, if you're going for a neutral Iron Condor, you want to go somewhere within around 16 to 20 deltas when you're constructing the short strike. So let's say on the put side, you want to find something maybe like 18 deltas, but you can't find one, right? You have to go for either 15 deltas or 20 deltas. But what about on the call side, right? If you take a look at the call side down here, if you want to go for something like 18 or 20 deltas, you can't, right? You have to jump to either 16 delta or 23 delta. And what they will affect is actually the kind of premium that you'll receive, and also, your prop, right? Which is the probability of profit. Now, what about index ETFs? So this is of SPY. As you can see, SPY is much more expensive than CRM, right? SPY is $400 over, whereas CRM is about $250. But despite being even higher priced, you notice that the strike differences is 1 point. So there are so many strikes for you to choose from. And if you were to take a look at the delta difference, it's so much closer to each other as well, right? There are about only 2 delta difference from each other. So on the call side, also same thing, about 1 to 2 delta difference from each other. And this is where you have more flexibility in the way you actually construct your Iron Condor, right? So these are the reasons why we want to choose index ETFs over individual stocks. Now, let's get into this selection of index ETFs. And a lot of people have been asking me, so Davis, which index ETFs do you think are good to actually, trade options or to trade Iron Condor specifically? So one thing to understand is that although we have been talking that, index ETFs is the preference over individual stocks when we are choosing them, right, in terms of trading our strategies. But the thing is that not all index ETFs are actually created equal. That means to say there are certain index ETFs you do not want to trade at all. So let's get to the point. Which index ETF should you trade your Iron Condors on? So I'm going to give you 4 of them. And the very first one is none other than SPY, right? SPY is the most popular index ETF, probably the most widely traded one in the world, right? Has the most highest volume, most liquid one. And SPY is the S&P 500 index ETF. So for those of you who are new to trading options, or maybe even to the investing or trading world, then this is the one that most people default to trade right at the start. So why trade the Iron Condor on SPY? Right, the very first reason is because it's extremely liquid and it's a highly traded index ETF. Now, next and very important one is that statistics have shown that the realized move is smaller than the expected move. So this is very important to understand, guys, because when we are trading Iron Condor, what we're actually doing is that we're trading the expected move. Now, if you're not sure what the expected move is, I've already created a video on it. Just go to my channel, right? The title is the #1 secret to becoming consistently profitable. So there I detail exactly what is expected move and how we can use it as an edge when we're trading options, right? So the key thing to understand is that for our Iron Condors to be net profitable in the long term, to have an edge, the realized move, right? That means the actual move in the market has to be lesser than the expected move. So the expected move is pretty much the theoretical price that is being given, by the options pricing model. So if you can have the realized move is lesser than the expected move on the underlying, then you know that we have an edge when we're trading the expected move with strategies such as the Iron Condor. Okay, so as you can see down here, SPY, this is again a study done by the Tasty Trade team, and they have shown that regardless of the volatility, you can see that the realized move is lesser than the expected move in all instances, right? So some people have mentioned that, hey, the index ETF do not have that high of a volatility, so maybe we don't have that much of an edge. But if you notice down here, even during times of very low volatility, what's important to understand is that your realized move is still lesser than the expected move. As long as that is the case, regardless, even though if you get lesser premium in the long term, you still can become net profitable. Now, more importantly, studies have already proven that the Iron Condor is profitable on SPY in the long term, right? Again, this is a study done by the Tasty Trade team. As you can see down here, what they've done is that they put on a 20 delta Iron Condor, which is $10 wide, right? What does it mean by 20 delta? That means your short call and your short put, all right, down here, this is 20 deltas, right? So they went for the 20 delta short strikes, and then you have $10 wide on your wings, right? So that means from here to here is $10 wide. Same thing as the other side as well. Okay, so what they did is that they pretty much just put on this iron condor, and then they have two different management style, right? They have one where they just get out of expiration, right? They hold it all the way to expiration and then put it on again after that. And the other one is at 21 DTE. That means once there's 21 days to expiration left, they close out the trade and then they put on another iron condor. All right, so they just do this continuously, and as you can see, in both cases, they are actually profitable. Although, holding to expiration, towards 2011 onwards, you pretty much have, not too good of a performance, right? So that is why when it comes to trading the iron condor, we want to manage them at 21 DTE. Basically, it's just to exit our trade at 21 DTE. Now, the key word down here I want to emphasize on is in the long term, right? Because a lot of people straight away see this chart and graph and thinking, hey, it's going to be profitable. And they jump into trading, this iron condor without really understanding this chart, right? Because they think that, hey, every day is going to be profitable or every month is going to be profitable. But what they don't realize is that there'll be times where you could go through a drawdown, right? Some people go through, a losing streak of maybe 3 trades and they think that the iron condor doesn't work. But if you were to really just zoom in into this chart down here, you will notice that there are times where there are drawdowns, right? You can see that there are drawdowns at quite a number of times. Then these are the times where when you put on the iron condor, you're going to lose. And it's possible that you're going to lose multiple trades in a row, right? Because the conditions are just not suitable at that point of time when you're putting on the iron condor, or the market have just, bigger movement than usual, right? Maybe it just exceed the expected move. So as you can see down here in 2009, there's a period of time whereby, if you were to put on the trade or you got into the iron condor during those times, you could have lost money. It took a while before you got it back. Same as 2011, 2013, even 2016 and 2017. Towards the end, right? But what you need to understand, this is the long term, right? So if you get into a point where you started to trade the iron condor and you realize that, hey, you've been losing, a few trades in a row, just realize that this is all part and parcel of trading, right? If you go and listen to other people, YouTube videos where they say that, you cannot lose money trading iron condors, then I would be very wary of them, because every strategy you put on always have some kind of risk. So the most important thing to understand down here is that when you take a look at this chart down here, it says the average realized move and the average expected move. Average just means it's everything add up together divided the number of instances, which means to say there are certain times where the price underlying can actually exceed the expected move. So when you aggregate them all together in the long term, that's when the average realized move will be lesser than the expected move, which means to say you do expect such kind of drawdowns from time to time. So that is why very important when you're trading the iron condor along with any other strategy, you want to look at the long-term profitability rather than just the next few trades, right? So this is one thing that I always mention, always look at the next 100 trades instead of the next 3 to 10 trades. Now the next index ETF that I think is really good for trading the iron condor is the IWM. So the IWM is the Russell 2000 Index ETF. So why trade the iron condor on IWM? Well, same thing, it is also very liquid and highly traded, and it is lower priced than SPY, right? Which means you can actually construct a less capital intensive iron condor, right? That's with dynamic wings, or a relatively less riskier iron condor with fixed wings. So here's exactly what I mean. Right, so let's just take a look at the dynamic wings right now. So dynamic wings, basically what it means is that when you're constructing the long side of your iron condor, you're looking at delta instead of dollar points, right? So let's say, for example, we have an iron condor structure down here. All right, so this is for the call side, and then you have for the put side. All right, so down here you can see the example used by the Tasty Trade team is that they're using the 16 delta options, right? So this is 16 delta for the short call and for the short put. Now, what about the long put and for the long call? So this is where instead of, usually what most people do is that they find a $5 wide, right? Either $5 wide or $10 wide kind of wings. Instead, this time, what you're going to do is by looking at the delta. So let's just focus at the 10 delta wings. So what it means is that you go all the way to the 10 delta on both sides, and that's where you place your wings, right? So how much risk is that? It really depends on the volatility at that point in time, right? If the volatility is high, then the 10 delta wing could be quite far apart, right? But if when the volatility is low, then the 10 delta wing will probably be nearer to where the 16 delta is. So this all really depends on, the underlying volatility. So basically what this means is that you're using the long wings, right? You're defining them by using delta. So as you can see down here, this is a study done by the Tasty Trade team, and they measured all different types of wings, right? They tested the different kind of wings with the 16 delta short strikes. So as you can see, in all cases, they are actually all net profitable. So this is the average P&L, right? Which means to say, as you can see, it's a positive number. That means it is positive in the long term overall. Now, so why is this less capital intensive? So let's take a look at the option chain to understand this a little bit better. So as you can see down here, this is of SPY. You can see that we have the short option down here at 16 delta, and we have the long option where we define the wings at 10 delta. So this is only on the put side, right? So I'll just show the put side because the call side is going to be similar. So as you can see down here, if you reach to the 10 delta, it's going to be $10 wide, which means to say your Iron Condor risk is roughly going to be, about $1,000 less the credit that you receive for, this structure for this Iron Condor. So it should be roughly around $800 to $900 risk depending on how much credit you can get, right? So this is for SPY. Now, what about for IWM? Now you notice for IWM, if you were to use the same delta, 16 and 10 deltas, it's only $5 wide, which means to say your risk for this trade is less than $500, right? Once you minus off the credit you receive for putting on this structure. So which means to say if you have a smaller starting capital, then you might want to consider going for the IWM instead of the SPY. And let's say, for example, you have a bigger capital where, you're able to risk about $1,000 per trade, then this is where, you could choose to go with the SPY, right? So that is why I say it's less capital intensive when it comes to the dynamic wings. Now, what about for fixed wings? That means you have a fixed dollar wing, right? Either $5 or $10. It is actually less riskier when you use it on the IWM. Why? So let's take a look at the SPY down here. So again, the SPY, we go for the 16 delta and we go $5 wings. So if you go $5 wings, will be the 440 strike. And you notice it is at the 13 deltas. Whereas for, for the IWM at 175, which is $5 away, it is at 10 delta. So delta actually gives us also an indication of the likelihood of it being in the money at expiration. Right, so for example, a 13 delta long win just means that at expiration, there's a 13% chance that this will be in the money. Whereas for IWM, right, the same $5 wide away strike is only 10 deltas. That means there's only 10% chance that it's going to be in the money, right? Slight difference, but as you can see from here, it's slightly less riskier on the IWM compared to the SPY, right? So that is one of the another reason why you might want to consider choosing IWM over SPY when you're just starting out. Now, the final reason, and most importantly, is that statistics have also shown that the realized move is smaller than the expected move, right? This is the whole reason why we can have an edge when we are trading the Iron Condor. So that's also one of the reasons why I generally do not like to trade individual stocks when it comes to trading the Iron Condor strategy, is because most of the time, right, the realized move can be bigger than expected move, especially when the earnings come or when there's, individual stock news, like for example, maybe they have a bad product launch, or maybe, the CEO, something happened to him. There's going to be a big adverse movement where it's going to affect, the price movement. It's going to most likely have a very big gap up or down. All right. Now, you might be asking this question right now after I've just shared with you this 2 index ETF. But Davis, I'm afraid of getting assigned if my Iron Condor is in the money, right? So this is one of the biggest fears that many people have, is that their Iron Condors get in the money and they're afraid of getting assigned, right? That means if you're getting assigned, if you get assigned on the call side, you're going to be short 100 shares of the underlying, or if you're assigned on your short put side, you're going to be long 100 shares. And this is going to have margin call if you do not have, sufficient funds to actually, buy those 100 shares or short those 100 shares. So this is where the fear that a lot of people come. So first of all, if you actually get assigned, please go ahead to take a look at my video. I already have a video which I've already created called the Iron Condor Reversal Strategy, where I just share with you exactly what to do if you're assigned. But second of all, if you're totally afraid of getting assigned at all in the first place and you do not even want to have this early assignment, then don't worry, I got your back. Then you want to trade these 2 underlyings instead, and that is the XSP. All right, so the XSP is actually a cash settled index options, and it's essentially the cash settled version of SPY, right? It's the mini SPX index options, which is the same size as SPY, right? If you notice on the left hand side, this is SPY, on the right hand side, it is XSP, and you notice that the price movement is virtually the same, right? They're actually exactly the same. The only difference is that one is European options, which is XSP. That means you do not get early assignment, right? And it's cash settled, whereas for SPY is American options, right? The other difference is that, the price difference is just, by maybe $1 or $2 away, right? As you can see on the SPY is about 467, whereas on the XSP about 469, right? But it's not that much difference. So why trade iron condors on XSP? So first of all, it is cash settled, which means that there is no chance of you getting assigned shares. Hence, there's no need for you to worry about getting into a margin call. So this really helps out a lot of people in terms of their fear of getting assigned, because there's no way you can get assigned shares on XSP. Now, next, there's no early assignment, right? You can hold all the way to expiration if you choose to. So XSP is on the European style option, which means to say the buyer of that option can only choose to exercise the option at expiration. They cannot exercise it before that, even though it's in the money, right? This is unlike the American style, which is on individual stocks and index ETFs, whereby if it's in the money, they have the option to actually just exercise it at any time they want, right? But for XSP, no such thing. So again, no need to worry about early assignment. And if you hold to expiration, basically the broker will just settle the P&L in cash, right? So again, you do not have to worry about any share assignment, because that does not happen. So people have asked me before, what actually happens at expiration, right? Let's say, for example, if you lost money. If you lost money, basically the broker will just settle any P&L in cash, right? So you will just take a look at your cash side. And if you lost money, right, basically the cash will be taken out of the account. And if you have profitable, the credit will just stay there, right? Or if you have just, maybe 50% profit, the broker will just remove like 50% of the credit which they gave you right at the start, right? So basically it's all settled in your cash account. So essentially it's the same as SPY with slightly wider bid and ask spread and slight price difference, but for the most part it's essentially the same. So if you're worried about getting assigned, just trade the iron condor on XSP. Now the next one is MRAT. So what is MRAT? So MRAT is essentially the cash settled version of the IWM. So for XSP is the cash settled version of SPY, MRAT is the cash settled version of IWM, and it's the mini RAT index options, which is the same size as IWM. As you can see, the price movement is exactly the same, right? There's not much difference in terms of the price movement. So why trade iron condors on MRAT? Well, first of all, it is cash settled, which means that there is no chance of you getting assigned shares, hence no need to worry about margin call. Same thing. Again, same thing, no early assignment, right? You can hold all the way to expiration if you choose to. And if you hold to expiration, the broker will settle the P&L in cash as well. And essentially the same as IWM with slightly wider bid and ask spread and slight price difference, which doesn't make too big of a difference when you're trading it. And it is lower priced than XSP, which means you can construct a less capital intensive iron condor with dynamic wings, or a relatively less riskier iron condor with fixed wings. So basically it just means to say that if you have a smaller capital, if you're just starting out, you want lesser risk, then just go for the MRAT.
This is an iron condor that I put on for the spiders. Now I have many different trades on the index ETF, so this is just one of the many trades which I have on. So this is a skewed iron condor. So basically a skewed iron condor is whereby you have very different size width on each side. So as you can see, for the put side, it is slightly bigger than on the call side because of the skew, right? So for index ETFs such as the spiders, the QQQs, IWMs, they have put skew. So basically what it means is that your options on the put side will be slightly more expensive, and that's only because the perceived risk by the market is to the downside, right? So at the same time, when you put on this skewed iron condor, you'll notice that for the put side, it's always going to be wider. So what this iron condor is basically I have 16 deltas on both sides for the short options, and for the long options, right, they are both 5 deltas, right? So you can go ahead to your option chain and you notice that for the 16 deltas as well as for the 5 deltas, they are pretty much further away from each other. in terms of distance from the market for the put side and the call side, right? So for example, the put side, you'll notice that it might be maybe $20-$30 wide, but whereas on the call side, it might be only maybe $20 or $25 wide. All right, so this is the difference between a normal iron condor and a skewed iron condor. So if you're just starting out, I don't want you to be too concerned or too worried about this. You might just want to go with the standard width, which is maybe like $10 wide on each side. All right, but in terms of how you manage this losing iron condors, they are the same. All right, they're pretty much the same. All right, so in this case, you can see that this is an iron condor. So the iron condor is very different compared to the credit spreads, because if you were to put on just a bull put spread, let's say for example just a bull put spread, and the market was to trade up from this point in time, you're going to see that your put spread is going to be very profitable, right? You're going to be in profit immediately, no matter how far it goes above. Similarly with the credit spread for the call side, the bear call spread, if the market goes down, then you're going to see a profit on the call spread. All right, but for the iron condor, because you have on both sides, right, the combination of both the bear call and the bull put, it's very easy for you to see a loss at any point in time during your trade, right? At any time when you're holding on to the iron condor for days or weeks, right? It's quite easy for you to see a loss because you have this friction on both sides. So if the market is to go up, all right, even just a little bit, maybe somewhere down here, you're going to see that your put spread is going to be in a profit, but your call spread is going to be in a loss. Similarly, if the market just trades down a little bit, you're going to see a profit on your call side, but then your put spread is going to be in a loss. So overall, it will come down to a loss. All right, so you do not want to panic when that happens, because it is very common, it's natural. The way you make money on your iron condor is as time passes, then your profit will start to show. So for you to really understand how an iron condor works or behave, you want to take a look at the risk profile. Right, so this is the risk profile of the iron condor, right? A normal width iron condor with $10 wide on both sides is also pretty similar. So what you will notice is that there are two lines, all right? So you will see the green line. So the green line is basically the risk profile, or rather the P&L graph for it when it hits expiration, right? When it's at expiration. Whereas for the purple line, it's the current day. Right, so when you put it on, you'll see this purple line, and over time this purple line will conform to this green color line down here. Basically it will change. So from this point on, you can see that the purple line, right, over time as it goes closer to expiration, it will go up closer to this green line, whereas when it goes past this point, it will start to go down to conform to this green line down here. Similarly down here as well. So you can see that as long as the market just moves, even though it moves, you know, it doesn't really have that much of a big move to test your short strikes, right, on both sides, you can see that it can be in a loss. All right, you can see that at this point of time, let's say it goes to this point down here, let's say it comes down here, right, let's say the market made a big move, it comes down here, you will see that it's in a loss. Okay, but it is still well within the profit zone of the iron condor, because the iron condor profit zone, as you can see, is from this point all the way to here, right? So this is actually past your short strike. So your short strikes are at this point. This is where your short strike is, this is where the short put, this is where the short call is, and then your long call, sorry, your long call is here, and your long put will be down here. So what you want to take note of down here is where your break-even point is. So let me just remove all these drawings. So the point you really want to take note is this break-even point. So that means past this point at expiration is where you will start to lose money. Anywhere within there, as long as it stays within this break-even point, this two break-even point, you're going to be in profit at expiration. So with this in mind, what you want to do is take note of the break-even point. So you can see the break-even point on both sides. It will be, they'll show exactly what is the amount, so you can actually put this on your chart. You can put the points down there, something like this, right? So what you want to see is that if the market is still trading well within the break-even point, guess what? There is nothing to do, right? So if the market is inside the break-even point, do nothing, right? Do not be overactive where you try and manage it, where you try to shift this in, or you try to close out one side and hopefully, you know, the other side rebounds back. Ideally, if you put on as an iron condor, you want to exit as an iron condor as well, right? I'm not a big proponent of shifting this here and there if it doesn't actually go past your break-even point, because remember, you want time to be on your side. Time is on your side. You have theta decay, right? So Iron Condor is a theta decay kind of strategy where you have time decay working on your side. So as time passes, as long as it's within this zone, slowly this will go up. You're going to make money on this, all right? So with an Iron Condor, you want to give it time to really nurture, mature, and finally give you the profits which you want if it's inside the profit zone. Now, what if the market is outside of the break even? What if it really moves it has such a big move that it goes past your break-even point? Well, at this point, then this is something where you might need to do something, and it depends on whether it's past the 21 days to expiration mark. All right, so 21 days to expiration mark is a focal point on where you start to manage your options. And the reason why you want to manage at 21 days to expiration, well, one of the reason is because when you go past 21 days to expiration mark and your options, right, your short strike, your short call and your short put, when they are both in the money, this is where the chances of you getting assigned increases, right? If the market goes past this short put, that's less than 21 days, then your extrinsic value is decreasing rapidly by the day, right? So what determines whether your short strikes, whether your short call or your short put is going to be exercised by the buyer of this option comes down to how much extrinsic value there is left in this option. Well, basically the rule of thumb is that when there is very little extrinsic value left, then there's a very high chance for you to get exercised. And extrinsic value also got to do with how deep in the money the option is. That means if the option is really deep in the money, then there's going to be a lot of intrinsic value but very little extrinsic value. So that's when you're going to have a high chance, or rather an increased chance of getting assigned. And also as it gets closer and closer to expiration date, remember at expiration all options lose their extrinsic value, right? Extrinsic value goes to zero. So as you get closer and closer to the expiration date, you're also going to lose a lot of your extrinsic value, because that's when theta decay really rapidly increases to decay the value of the options, right? So when you're past 21 days to expiration mark, this is where your chances of getting assigned is going to be higher. But if it is above the 21 days to expiration mark, then guess what? You're going to still have a reasonable amount of extrinsic value because there's still quite a bit of time, right? So when there's quite a bit of time, usually the buyers of these two options, they won't really want to exercise the option, right? Because they will be losing the extrinsic value. They'll be giving up the extrinsic value if they exercise, right? The better way for them to actually manage it will be to just sell off the option and to reap the profits, right, with the extrinsic value. So it really makes no sense for them to really exercise it early if the extrinsic value is still pretty high. So a safe margin, or rather a good margin of safety where you know there's a lesser chance of getting assigned, is when there's more than 21 days to expiration. Now, the other reason why we want to manage at 21 days to expiration is because there has been studies already done, right, in-depth studies and research, that when you manage your trades, especially for, in this case, Iron Condor, when you manage it at 21 days to expiration, you will find that your results are actually better. Right, so if you can see, this is a study done by the Tasty Trade team. They have done really in-depth research into this. So for the Iron Condor, in this case, a 20 Delta $5 white Iron Condor, you can see that if you hold it to expiration, your win rate is only 66%. But if you were to close it out or manage it at 21 days to expiration, then your win rate is 72%. It's much higher. Right, at the same time, your daily P&L is higher as well. You can see this is 60 cents compared to 34 cents. So there is definitely much more benefit when you manage it at 21 days to expiration. And this is generally the rule of thumb, which is what we want to do when you are selling options, when you're selling premium. 21 days to expiration is the point where you want to start to do something. All right, so the other thing which you want to see is that you can see that the performance at 21 days to expiration when you manage it is significantly much better than if you were to hold to expiration, right? You can see that as time goes past, right, you trade past around from 2011 all the way to 2018 and so on, 2020, you can see that the performance of the 21 days expiration really outshines if you were to hold it to just to expiration, right? So that is the reason why I generally manage my options at 21 days to expiration. All right, so what do you do if it's outside the break even at 21 days, right? When there's still more than 21 days to expiration. Basically, when there's more than 21 days to expiration, you pretty much just do nothing, right? Just let the trade work out, let theta decay work in your favor, and you never know, right? The market can always come back up. If you were to manage too early, then guess what? You have removed the chances of you being profitable because you didn't give it enough time for the trade to work out. Don't forget, when you are putting on an iron condor, you've already got the long option in place, right? The long option basically already limits your maximum risk. So if the market goes to zero or it shoots all the way to the moon, you don't have to worry because you already have the maximum loss defined in place. You already know what's the worst result that can happen. And when you put on this trade in the first place, this maximum risk should be based on the capital allocation that you are comfortable with, right? That you are certain that, you know, even though if you hit the max loss, it's not going to destroy your account, right? So that's why it has to be a small percentage of your account, okay? So what do you do if there's less than 21 days left, right? If there's less than 21 days left and your break-even points have been breached, well, the first thing that you can do, the first option, the very simple option to do is to simply just take a loss, right? This is actually my default option and the one that I like best because for me personally, I have many trades on, right? I can be managing up to 20 trades at one time on the same product on the same index ETF. So for me to manage every single one of them is going to get so confusing, right? You want me to manage this by, you know, closing this or turning this to the different trade or to roll this in and out. It's too confusing for me, right? I'd rather just take my loss. So one thing that you want to understand is that you will have losses, right? So if you were to take a look at the P&L graph, you'll notice that you have a pretty high win rate, right? This is about 85%. But this doesn't mean you're going to win all the time, right? There are chances that you're still going to lose, right? There's 10% chance you're going to lose on the upside, and there's about 5 to 6% chance you're going to lose on the downside, right? But I know that I'm going to win the majority of the time, so there's no need for me to make sure that every single trade turns out to be a winner. If that trade at 21 days is a loss, then guess what? I'm just going to close it out, take the loss, put on another trade again. So that's the first option that you can take, the very simple one. Now, the next option you can take is if you are wanting to fight it back, right? That means you do not want to take a loss. There's nothing wrong with that. By the way, if you think that the market may come back or you want to hold on to it in case the market comes back, you can as well. So what you can do is to roll out the whole iron condor out if you can get a credit, right? So for example, let's say the market trades somewhere around here and it's still inside your strikes. So if it's still inside your strikes in this case, but it's already past 21 days, right? In this case, you can actually still hold on to the trade because if you were to take a look at the P&L graph again, all right, let's just remove all this drawing. Let's say it's somewhere down here, right, past 21 days to expiration. Maybe there's 20 days to expiration left. So if you were to hold on to this all the way to expiration, and given the fact we assume that the market actually stays here at expiration, guess what? You're still going to slowly profit because over time this purple line is going to go up to match this green color line. So you're still well within the profit zone, right? But the thing that you want to understand as well is that this line will start to get steeper as well. It starts to get steeper. As you can see, this line down here is pretty steep compared to this purple line. So as it gets steeper, what it also means is that as long as the market moves against you, that means let's say it continues to move down, then guess what? The loss you're going to take is going to be much faster as well because you're going to have an accelerated loss to the downside. But of course, you also have an accelerated gain to the upside because the curve is steeper as well. So at this point of time, you are quite subjected to the underlying movement, right? You're much more sensitive. So that's why it's kind of like a big risk, big reward kind of thing at this point because you can make more if the market moves towards the center of the iron condor, but if it moves away, you're going to lose more as well. So this really comes down to your decision, right? It's your discretion. If you want to hold on to it, Nothing wrong with that as well. The other alternative is to just roll the whole iron condor out, right? So chances are that if the price is still within the iron condor at 21 days, then guess what? You can roll this whole iron condor out for a credit, right? Chances are that you'll be able to get a credit. If it turns out to be a debit, then you do not want to roll, of course, because ideally we do not want to roll for a debit. We want to roll for a credit. When you roll for a credit, you're essentially also giving time for the trade to work out. At the same time, you're reducing the max loss as well. Although it's not going to be a huge credit, a little bit of a credit can help, right? So what I also want to show you that at 21 days to expiration, this is how the graph actually looks like, right? So you can see that the purple line starts to go up already. Slowly it's going up towards the green line, slowly going to turn into the green line. But there are still areas within this profit zone from here to here that you could still be in a loss, right? For example, at this point down here or at this point. So at 21 days to expiration, you can see that you are in a loss, although you are still in the profit zone. So again, at this point in time, roll out the whole iron condor if you want to put up more trades. So this way, when you roll out the iron condor, you're also smoothing out this purple line again. So this purple line kind of resets back, right? It resets back to this, so you're not as sensitive to direction, and you're just letting time decay work in your favor. But if you don't roll it out, then you could just hold it all the way to expiration or close to expiration. When it comes back in, then you can take profit as well. So this is just some ideas for you in case you plan to roll out the whole iron condor. Now, the third option you can do is to simply close out the untested side and then roll out the tested side if you can get a credit. So let's say, for example, the market goes down to test the put side. So let's say, for example, the market is at this point, at past the 21 days to expiration. So at this point, your call spread is close to a maximum profit, right? Maybe if you put on for, let's say if you put it on for $1, you might be seeing 90 cents in profit. That means it's worth 10 cents right now. So what you could do is you can just close out this whole call spread and then manage this as a single put spread by itself. So now you're managing as a bull put spread. So how you manage this bull put spread is that if you're able to get a credit, you could roll it out. If you can't get a credit, then what you can do is you can actually hold it. Hopefully the market does rebound back up. If it does rebound back up, you can either close out for a profit, or you could choose to roll it out again, right? So in this way, what you're doing is you're pretty much splitting up the trade, right? You're taking a profit on this so that, you know, you just live with the put spread because maybe you're still bullish on it. You think it's time for it to rebound because the market has been pretty oversold at this point. So if you did not close out this call spread, if the market goes out, then you're going to lose some of the profits that you have already gotten on this call side. So again, we don't know which is the best move, right? You never know which is the best move until the market moves, because if you close out this and the market goes further down, then guess what? It's better for you to hold on with this to at least get the remaining 10 cents to kind of like cushion the losses on this side. But if the market goes back up, then closing this out would actually be a good choice or a good method, because you have already gotten most of the profit out of this, and then now your put spread is going to be in a profit. So that is the third option that you can take. Now, the last option would be to roll the whole iron condor out and in the untested side. All right, so sounds complicating, but let me just explain it to you. So let's say, for example, the market goes down to test the put side, right? So the market for your put side is in the money past the break-even point. So what you want to do first of all is to close out your this call spread, and then this is what you call rolling in and out. All right, so basically what you're doing is that you are shifting your iron condor closer to where the market is, right? When you bring it down and then you roll it out, you get credit, right? Because when you are closer to the market, the credit which you have, the premium will always be higher. So what you're doing is that you are trying to get more credit and then at the same time also reduce the maximum loss. So when you do this, you can actually do this as a single roll, right? What you want to do is you're rolling out to a further expiration date and rolling down towards closer to the current price. So you're going to get a credit on this. At the same time, you can roll out your put spread as well. So chances are that if your put spread is really in the money, then it will be a debit. right? But you want to roll both out because you want to have both at the same expiration date. So ideally what you're doing is that hopefully the credit which you get for this is much more than the debit you're paying to roll this put spread out. So let's say, for example, if you're paying, let's say you're paying 50 cents to roll out this put spread, but then by rolling out and rolling down your call spread, you're getting a credit of, let's say, maybe $1.20. Then guess what? You're going to be in a net credit at the end of the day. You're going to have a net credit of 70 cents for doing this roll. So I know of some people who like to do this, because when you do this, you're reducing your risk. You're also giving the trade to work out as well in case you're right. But I generally do not like this method the most out of the four, right? I'm not a big proponent of this method, because although you have increased the chances, right, that the market may come back up, and you reduce your loss as well, but the thing is that you have reduced your probability of profit. You see, when you first start out your iron condor, you have a pretty huge zone, right? So this is pretty much around a 60% win rate or so, right? So you have put on a roughly 60% win rate, but then when you start to roll it out and down the call side, suddenly now you are left with a very small profit zone. So even though if the market goes up, guess what? You're still going to be somewhat in a loss, because you have reset the iron condor, and now your iron condor needs time to work out, need time to mature. So you have such a small profit zone. So if the market just goes a little bit higher again, guess what? You're going to be in a loss again. And this is where it gets, kind of tricky. What are you going to do then? So although there are some people that actually does this is not something that I like, but you can definitely reduce the loss, the maximum loss on your trade compared to when you first started out, right? So let's say if you put on a $10 white iron condor, and let's say you receive, let's say, $2.50 in terms of credit. So that leaves you with a maximum loss of $7.50 for the iron condor, right? The maximum loss. But if you were to roll all this, you get 70 cents in terms of credit, or let's say, for example, you get $1.50 in terms of credit, right? Then guess what? Then you're going to reduce this maximum loss from $7.50 to $6, right? If you get $1.50 in credit. So now your maximum loss is only $6 instead of $7.50, and you still can get a profit if the market really stays within this zone close to expiration, right? So these are the four options that you can take. My favorite one is this: take loss, and then the rest really comes down to up to you. You can roll out the whole iron condor if you can get a credit, or you can close out the untested side, and then the tested side you can manage it as though as a single credit spread, which I also talked about this in my previous video, which is how to manage losing credit spread. You can go and watch that video. Or if you want to be even more defensive, this is pretty defensive. What you're doing is you're rolling the whole iron condor out and then rolling in and out the untested side, so you get more credit to eventually reduce the maximum loss. All right, guys, so I hope this video has been very helpful, gives you a little bit more idea into how you can manage losing iron condor. So the biggest takeaway I want to give you for managing iron condors is that you do not need to make sure that every single trade you put on is going to be profitable, right? There will always be times where you have to take a loss, right? When you take a loss, just take it. Remember, the probability is always on your side as an option seller. You just want to put it there consistently, put it on consistently, and over time, let the edge play out, right? But on the other hand, you want to manage it, it's fine as well, so you can manage according to this. What exactly is rolling? So rolling is the simultaneous process of closing your existing trade and then opening a new trade, and then you want to do this for an overall net credit in a single order, right? So there's quite a bit to take in down here, but the important thing is that you want to have an overall net credit. That's because when you have an overall net credit, when you roll, what you're essentially doing is that you're increasing the max profit and you are decreasing your max loss, right? But if you were to roll for a net debit, then what you have done is you have reversed it, right? Instead of increasing your max profit, what you've done is you have decreased your max profit and you have increased your max loss. So you do not want to roll for a debit, right? Most of the time you want to roll for a credit. So how do you want to roll it? So as you can see down here, this is the original trade for the put side. So let's say it's trading at $1.12 right now. So to roll this, what you want to do is you want to buy back the original spread. So as you can see down here, you buy it back, and then you sell the longer days to expiration put spread, right? So you can see this is 16 June, which is roughly about a month out from where you initially place your credit spread for the put side, right? So if you want to roll the call side, it will be the same as well. Now, unlike credit spreads, there are a few ways to roll iron condors, right? You could just roll the short put spread out, all right? You do this in one single order, or you could just roll the short call spread out, or you could just roll both sides, right? If you want to roll both sides, then you get the credit for both sides. So the thing is that when you are rolling iron condors as well as rolling credit spreads, it's not all the time that you can get a credit, because there are times when the market goes deep in the money, chances are it's going to be a debit. So when you are rolling it, you want to just keep in mind about this, right? So the next question is how and when to roll, right? So when you are talking about iron condors, the first thing you want to think about is, where is your profit zone? Where is the part that you are going to make money? So once you have established that, then you know whether you want to roll or not, right? So for an iron condor, it's very straightforward. We know that the profit zone is within this short strikes, all right, from here to here. This is where you will be able to get your max profit, right? And then now we want to identify where is the point that you will start to lose money for your iron condor. So you can see down here, I have this orange color coded part down here. So this orange or yellow coded part down here is basically where your profits will start to diminish to the point where it becomes a break-even point. So down here would be where you pretty much don't make anything. So this is the $0 mark down here, and anything below the zero mark, and on the top side, anything above the 0 point, that is where you start to lose money, right? So to make things simple, we just only want to look at the part where it's in within this, short strikes, because this is the point whereby it's the most safest in a sense. Because if the market was to go all the way past down here, let's say it's still at the break-even point, the thing is now your call strike has been breached, which means to say there's a chance that you could get early assigned. So as much as possible, we do not want that to happen. So when do you roll? With this in mind, you can consider rolling when either the short strikes get tested, right, as I mentioned, and there's less than 21 DTE. And the reason for this is that when there's less than 21 days to expiration, the extrinsic value tend to be much lesser, right? You're going to have very little extrinsic value in your short options, right? In your short call and in your short put. So when there's very little extrinsic value and the market is in the money, right? Let's say it's in the money on either sides, right? Either the short put or the short call side, then chances are you could be early assigned when the extrinsic value drops to very little. So that is why we want to ensure that there's more than 21 days to expiration, because if there's more than 21 days to expiration, then there's still quite a bit of extrinsic value left. Remember, extrinsic value is just time value, right? So there's more time in it, there tends to be more extrinsic value, and that reduces your chance of getting early assignment even though it's in the money, right? So we want to use this as a gauge, which is less than 21 days to expiration. And last but not least is that you want to be able to get a net credit, because if you don't get a net credit, like I mentioned, then you're going to be decreasing your max profit, increasing your max loss. All right, so now we will go through the different scenarios that you might face, and then for each one we will see whether we should roll and how we should roll them if we want to. Okay, so for the first scenario is if the market is within the short strikes and there's more than 21 days to expiration, but your iron condor is in a loss, right? Although it's within your short strikes, you will notice that it could be in a loss. So in this scenario, there is no need to roll, right? Your short strikes have not been breached, so the iron condor is still working well at this point. So what I'll do is basically just do nothing and let the trade work out, right? Let theta just work for you over time, and slowly you will see that as long as it stays within the strikes, your P&L will slowly start to increase. Now, scenario number 2, the market is within the short strikes, same thing, but this time there's less than 21 days to expiration and your iron condor is in a loss as well. So in this case, what do? Should you roll? Well, the answer is that it's actually not necessary to roll, well, because the short strikes have not been breached, because we have identified that, remember, between these two short strikes, it's still in a profit, which means to say if time goes by, it still stays there, your temporary loss will slowly become a profit, right? Because this is the profit zone, it's well inside the profit zone. So I will do nothing, let the trade work out. But since it's less than 21 days to expiration, you want to be prepared to roll once the short strike has been breached. So if it touches this put strike in the next few days, then this is time where you want to be on alert and start to consider rolling your iron condor. Now, if you want to reduce your risk, you can actually roll as well, even though it's still within your short strike. So I've seen a few people that have done this, and when you roll it this way, you will almost always ensure that it's going to be for a credit, right? Because the price is well within your short strikes. It has not touched your short strikes, it has not breached it, so there's no chance for it to become a debit roll. So this will almost always be a credit roll. So that is why some people want to use this as an opportunity to increase their max profit and then decrease their maximum loss. So in this case, by rolling both sides out, which means to say you roll to the next nearest maybe 45 to 60 days to expiration, you will very likely get a net credit since both sides are out of the money. You can also consider rolling the call side out and down, which means to say you could roll it down. Maybe let's say you want to roll it to 410, 415. So this way, not only do you get a credit for rolling out, you also get more credit by rolling down because it's now closer to at the money. It's closer to where the current market is. So anytime when you roll it closer to the market, you're going to be able to get more credit, right? But take in mind that when you roll this down, what you're actually doing is also reducing your probability of profit. Because remember, when you first started out, this is your profit zone, right? Your profit zone is pretty big, right? But when you roll it down, suddenly now your profit zone has been squeezed from here to here. So true, you get more credit, but you are being compensated because now you have a reduced probability of profit. Your win rate is going to be slightly lower because your profit zone is going to be slightly smaller. So this is one thing you have to keep in mind. Now the next scenario is if the market has just breached the short put strike and there's less than 21 days to expiration. So basically this is what I mentioned early on. So what do? So this is the point where you want to roll. So how do you roll this? So there are a few ways to roll this. So the first is that you can roll the short put spread out. So at this point, again, because it has just touched your short put strike, chances are that you are going to get a credit, right? You're going to get a positive credit to roll this put side. Then at this point, what you could consider is that you could also roll your short call spread out, then you keep the same strike, right? So if you roll this out, chances are you'll get a credit, but not that much, okay? Or you could roll the short call spread out and down, like I mentioned. You can roll it down here to 410, 415, or if you're not that aggressive, maybe you can roll it down to 415, 420, and just take a look at the kind of credit which you get. Remember, if you roll it down further, you get more credit, right? Let's say this many dollar sign means you becoming more richer, okay? So you get more credit, but then you reduce your profit zone. So that means your win rate actually goes down, right? Your win rate actually goes down. But if you roll it just to the 415, which is not so close to the market price, then what happens is that you will roll for credit as well, but maybe you won't get that much, right? Maybe just $2 signs. But this way, at least you have a larger profit zone. But of course, if you just want to roll out to the same strikes, then you still get a credit, but it's just $1 sign for you down here, but you remain your profit win rate down here, right? Your win rate is still going to be the same. So there's going to be a trade-off for each one. Or alternatively, you could just simply close out your call spread, and then you do not have to worry on the top side. So even though if the market suddenly bounced up and rallied all the way to the moon, there's no need for you to be afraid because you have no longer a call spread down here, right? All you have is just a short put spread, and this short put spread, as the market rallies, is going to be in a profit, all right? So these are the three ways that you can roll it out for this scenario. Now, scenario number 4, the market has just tested the short put strike and there's more than 21 days to expiration. So what do? Do you roll it or do you just do nothing? Well, in this case, I'm more inclined to do nothing. It's not necessary to roll, but you can roll if you want. And the reason why I feel that, it's not really necessary to roll because there's still more than 21 days to expiration. So for example, if you put on this trade at 45 and all of a sudden next day, for some reason, the market just tanked. So what's going to happen, right? Maybe one day has gone past, it becomes 44 days to expiration. If you're going to roll this right now, you may have to roll to the next expiration date, which could be around 60 days. So this will further increase the time in your trade, and theta don't really kick in until it's much closer to expiration. So at this point of time, it doesn't really gain you a lot on a day-to-day basis when you're starting from 60 days to expiration, or even longer than that. So basically, I wouldn't say there is a need to roll, so I can just do nothing, let the trade work out, and since there's still many days in the trade, the market can always go back up into the profit zone. Alright, scenario number 5. Now the market has gone far below your short put strike, and there's more than 21 days to expiration. So what happens if the market really tanked, right? Or it may have really gone all the way up. So I'm just doing this for the put side as an illustration, but of course on the call side it would just be the opposite. So just try and imagine, basically it'll be the same way you manage it, whether it breaches the put side or the call side. So in this example, let's say the scenario number 5, it breaches the put side and it goes all the way deep in the money, right? Maybe even past your long put strike in this case. So what do? Do you actually roll? So in this case, I will actually suggest to do nothing, because even though if you want to roll, chances are that you wouldn't be able to get a credit for this, right? Chances are it will be a negative, it will be a debit for you to roll the put side, because it has gone so far in the money. It will not be possible for you to get a credit at this point. So you could try the roll down the call side as well, but then again, the credit which you receive here may not be more than the debit which you paid on the put side. So it really depends. But in this case, because there's still more than 21 days to expiration, I just want to let the trade work out, right? It could just go back up again. And even if it doesn't, remember, this is an iron condor trade. It is not an undefined risk, right? Undefined risk, like for example the short put, or maybe the strangle, where there's no long put or the long call to cap your maximum risk. At that point of time, then you may find it a little bit more risky, because if the market really goes all the way down or all the way up, you could lose a lot of money. But this is the iron condor. The iron condor has already an inbuilt stop loss in place, so to speak, right? Because you already kept the maximum risk to the width down here, and this risk which you first set at the start, you should already have accepted it, that there is always a possibility that you could lose the max amount with any trade that you put on. So that is why this is where capital allocation comes in, right? One part is to manage it. The other part, if you want to really be profitable in the long run, then you need to be good with your capital allocation. You want to make sure that you allocate not too big, right? You don't want this to be like 25% of your account, and then you're going to be very worried with each trade. Instead, you should want to allocate maybe at most 5 to 7%, depending on how big your account is. If your account is much bigger, you want to allocate lesser than 5%. So this way, any single trade, even though if it goes wrong, hits the max loss, it's not going to affect you that much, right? You've got many other trades to come, and we know that as long as you stick to the guidelines, the rules, you're going to be profitable in the long run. So that is why if it goes all the way deep in the money, there's still time left, I'm just going to let it work out, right? The chances of getting an early assignment is still pretty low, because there's still more than 21 days to expiration, which means there's still quite a bit of extrinsic value left. Now, if you really want to roll this, the other way you could do is to roll it down into a butterfly. That means it becomes a butterfly. So what you want to do is that you want to roll this all the way to where the short put strike is. So if you will take a look at the P&L graph for the butterfly, it looks something like this, right? So as you can see down here, this is where, in the center, this is where your short put and your short call strikes are. So the profit zone is going to be very small. But in this way, at least you will definitely still get a credit. So you'll be rolling for a credit, you'll be increasing your max profit and reducing your max loss. But it's also good at saying that, you've given up on wanting to make money on this trade. So whenever you roll into a butterfly, you pretty much have thrown away most of your chances of actually making money on the trade. What you're doing is just saying, I do not want to lose a lot of money. I don't mind not making money, I just don't want to lose a lot. And that's the time when you roll to a butterfly. So this would be the last resort, but as I said, there's more than 21 days to expiration. There's no real need or hurry for you to really roll into a butterfly just yet. Alright, scenario number 6. Now the market is still below the short put strike, and it has just reached 21 days to expiration. So in this case, it's a follow-up from scenario 5. So basically the market has gone past your put strike, but it never came up, right? It basically just stayed somewhere around here. So at this point of time, you definitely want to try and roll, right? That's one thing. You want to see whether you can get a net credit for the different kind of rolls, right? So first off, you want to roll out the put side. So chances are that this will most likely be for a debit, right? It will be for a debit. So how are you going to roll for a credit? To roll for a credit, right now what you want to do is to roll out and down your short call spread. So as I've mentioned earlier on, you can just roll this down. So let's say if you try and roll it to the 410, 415, now you want to see, is this credit which you get down here, all right, this credit, is it going to be more than the debit over here? If you receive, let's say 50 cents for this roll, and your rolling down here is for a negative 70 cents, a debit 70 cents, then this is going to be a negative roll, which is not what you want, right? You're rolling for net debit. So what you want is that this has to be a much higher credit than what you're rolling this debit for. Then it would make sense for you to roll. So let's say if you roll to 410, you see that, you cannot get a credit. What you want to try and do next is to roll into a tighter iron condor or a butterfly. Basically, you just try and see the other strikes. Will it give you an overall net credit? So you try the 400 and you try the 405. If this still doesn't give you a net credit, then the last resort is to go to a butterfly, as I've mentioned in the previous scenario. So if now you roll to a butterfly and you're able to get a net credit, then yes, you can consider rolling. But what do you do when the market has gone so deep in the money and that no matter how you try and roll your iron condor, you just cannot get a credit, right? So there are two things you can do. The first of all, of course, you can just simply close the trade out. Remember, you do not have to win every single trade. There will be trades that you lose, right? In the long term, you manage your risk well. There is going to be a good chance you're going to be profitable in the long run. Now, the second option would be to hold on to this trade, right? You could hold on to the trade in hopes that the market could come back, a little bit further up first, and then you see whether you're able to roll for a credit, right? Because there are some times where the market will suddenly have a breather, maybe it retraces up. Then if you are not already assigned on your put option, right, on the downside, then you could try and roll this down. All right, roll this call spread down and see whether this time you're able to get a credit, right? But of course, there's always a chance that your short put could get assigned. If your short put gets assigned, you will be long 100 shares. This is where you need to know how to unwind this position. But if you don't want to go through all this hassle, then the easiest way is to just close out your trades. So these are the 6 scenarios I believe that I've covered most of the situations that you would be in, and this is when you may consider rolling your iron condor.
So first of all, when are you most likely to get assigned on your iron condor? Well, the answer is that when either of your short legs goes in the money, right? So one of the things that you need to understand is that you can only get assigned on either the put side or the call side, right? There's no way for you to get assigned at both places at one time, right? Because the market can only be at one place at any given time. So it's either you get assigned on your short call on your iron condor or on the short put, right? So the time when you have the highest risk of getting assigned is when the extrinsic value of the short leg is very little, right? And that's usually when there's not many DTE left and when your short leg is deep in the money, right? So when your short leg is really deep in the money, right? Let's say, for example, for the call side, basically the market has just blown through your call spread, or on the put side, the market has gone way past your put spread. So this is time where your short put strike and your short call strike is going to be very deep in the money, right? So deep in the money, this is when you're going to have very little extrinsic value and a lot of intrinsic value. So another thing that you want to take note is that for the call spread and the put spread side, there's a slight difference, right? The slight difference is that for the bear call spread side, which is this call spread up here, basically for the call spread, you have an additional risk, which is what we call the dividend risk, right? Dividend risk is basically when the underlying that you're trading, be it an individual stock or an index ETF, is going to pay out a dividend. So this is a time where you want to take a look at the dividend paid as well. So the time when you're going to have the highest risk of actually getting a sign on your short call strike is when the extrinsic value, all right, let me just write it down here. Your extrinsic value is lesser than the dividend that is going to be paid out, right? So let's say, for example, if your extrinsic value left on this short call, let's say it's about 30 cents. Okay, so let's say it's 30 cents. This is a dollar sign, by the way, on the left hand side. It's less than the dividend. Maybe the dividend is paying out 50 cents, right? So during this time, you could have some dividend risk because the buyer of this call option right now, remember, now you are short the call option. So on the opposite side of the trade is the person will be buying this call option. So the call buyer has the option to actually exercise his call option. And when he exercises his call option, he's basically going to be long 100 shares. So if this call option buyer, he was to sell off his just call option, just sell it off without actually exercising, he would only get 30 cents. But if he was to exercise it and then actually get the dividend, when the dividend gets paid out, he's going to get 50 cents. So there's more incentive for him to exercise. So this is very important for you to really take note of if you have any short call option that is in the money and the underlying actually pays a dividend. Now on the bull put spread side, which is basically just the put spread, there is no dividend risk, right? There's no dividend risk, so you do not have to worry about it at all. So even though if the market, goes way below your put strike, you don't have to worry about the dividend, right? It does not affect it at all. And the reason why it doesn't affect it at all is because on the opposite side, the person is actually holding on to a long put. So with a long put option, if he exercises it, he will actually be selling 100 shares. So if he's selling 100 shares, he does not get any dividend. The only time you will get a dividend is if that person actually owns the shares. All right. So that is why there's no dividend risk for the put spread side. Okay, so let's talk about the put spread side first. So what happens when you're assigned on your short put leg? So basically, when you assign on your short put leg, you will now be long 100 shares at the strike price, right? So let's say, for example, the strike price is $100. So what this means is now you'll be long 100 shares at $100. So the total capital you have to put up for this would be $10,000, right? So if you do not have $10,000, then this is where you could get a margin call, right? So $10,000, most brokers would want you to put up 50% of it, right? So if you're on a margin account, by the way, if it's a margin account, you have 50% margin by default. So you only have to put up $5,000 for that. And if you do not have this $5,000 in your account, then you're most likely going to get a margin call. So at this point, what do you do? Right, so some people have mentioned that all you have to do to unwind this, all you have to do is to just exercise this long put option. Because if you exercise this long put option, what's going to happen is that it's going to sell away this 100 shares that you have. So this way you have no more positions on the bottom side, right? But the problem with this is that you are actually going to realize the maximum loss of this spread down here. Because don't forget, when you are exercising this put option, what you're doing is that you're telling the broker that you want to sell 100 shares at this strike price down here. So if you bought 100 shares at this strike price, let's say, for example, this is $100, the strike price, and then let's say down here is $90. So what's going to happen is that you are going to buy at $100 and you sell at $90, and you have just realized the full loss down here just to clear out your shares. Now, this is not an optimal way to do this, because if you were to just close out this position by itself, that means you were to sell off the 100 shares and then you were to sell this put option, you're actually going to lose lesser. The reason you're going to lose lesser is because this put option at the bottom down here, this long put option, still have some extrinsic value. And when there's extrinsic value left, it's going to help you actually cushion the loss of what you're making on this 100 shares. So you're actually better off if you just close out this position rather than exercising the put option, right? But this is still not the best way to do things, right? Because if you were to do it this way, what happened is that now you're suddenly no longer having an iron condor, right? All you have is just a call spread on. And if the market suddenly shoots back up, now your call spread is going to be in a risk. So what should you do instead? So here is 3 very simple steps to unwind your assignment, right? So the very first thing you want to do is to just sell off this 100 shares. Once you sold off this 100 shares, you're not going to have any positions. So it's just going to leave you with this long put option at the bottom. After that, all you have to do is sell the original short put strike. So again, if this short put strike is at $100, when you sell the short put strike, you're going to sell the same place as well, right? And you're going to sell the same DTE as well. So let's say, for example, maybe this has 10 DTE. So you're going to sell the 10 DTE as well. And the reason we want to do this is we want to do this step by step, right? Because if you plan to actually roll it and you roll it to maybe the 30 DTEs, then what's going to happen is that your short put strike is going to be 30 DTE, and now you're going to have a long put below that's 10 DTE, and the call spread is going to be 10 DTE as well. And it's going to be very confusing. So we want to do this step by step, very mechanical approach. So step 3 actually is just step 1 and 2 done together. So if you think about it, it's really just one step. So what it means is that if you get assigned, what you want to do is try and do it in a single order ticket if you can, right? Most brokers have this functionality. So you can see down here, you can sell off this put option and then sell the 100 shares at the same time, and then you will get back your credit. And what's going to happen is going to also relieve your margin call. So what do you do after unwinding your assignment? You're not out of the woods yet, because remember, this short put down here is back to the original DTE. So let's say, for example, it was 10 DTE, which means to say that this 10 DTE has a chance of getting early assigned again, because it was early assigned before, and right now you still have pretty much the same position, so it could get early assigned again. So now some people may just want to hold on to the spread and see maybe the market can go back up. Yes, you can do that, but just be aware that you could be early assigned again, and you have to do this whole 3 steps all over again, or rather just this one step down here, step 3. So what can you do instead of this to avoid this early assignment? Well, there are 2 options. Well, the first option, a very simple one, is to just simply close out for a loss that is lesser than a max loss, right? It's better than if you were to exercise this put option when you had the long 100 shares, right? So just close out for a loss and then wait for another opportunity. Remember, there is no need to win every single trade, right? As long as you put on the Iron Condor with the right mechanics, over time you should be able to be profitable. Now, what about option number 2, right? Option number 2 is if you still want to hold on to this Iron Condor and you think that the market has a possibility of it coming back up. Now, if this is the case, then option 2, you can go with this. Basically, what it is to roll your put option. First of all, you want to roll your put option to a further DTE. So let's say, for example, it's at 10 DTE. And then to roll to a further one, let's say you roll to the next 45 DTE, okay? So when you roll this to 45 DTE, it's likely that you're going to roll for a debit, right? So this is going to be for a debit. So let me write the word down here, debit, DBT. So this will be for a debit because your price, the market, is actually in the money. So most of the time, the in the money put spread, if you were to roll out, is actually going to be for a debit instead of a credit, unless this price right now, this market price, is somewhere near where the short put is. So a general rule of thumb, if the market is nearer to the short put strike, then you can roll for a credit. But if it's closer to your long put strike, and if it's way past your long put strike, basically below your long put strike, then it's going to be for a debit. Now, once you have done this, the next thing you want to do is to deal with the call spread side, because right now the call spread side, you can actually roll down and out. When you roll down and out, you actually get credit, and this can actually offset whatever debit that you have when you are rolling the put spread. So overall, you could actually still get a credit for doing this. So by the way, if you're not sure how to roll an Iron Condor, I actually have a video on rolling that. Just go to my channel and then look for that video. All right. So these are the 2 options that you can do after unwinding your assignment. All right, so now let's get into the call spread side. So what happens when you're assigned on your short call leg? So this is the opposite of the short put. So if you're assigned on your short put, you get long 100 shares. But if you get assigned on your short call, what happens is now you'll be short 100 shares at the short call leg strike price. So when you look at your positions, suddenly you won't see an Iron Condor, but rather you will see this position down here. You will see that you have short 100 shares at whatever the strike price is. All right, let's say maybe this strike price down here is at $120. So what happens is that when you short your shares, you again have to put out margin, and this is where you could get a margin call if you don't have sufficient funds to short the 100 shares. So in this case, what do you do? So again, people have mentioned all you have to do is just exercise this call option. But again, as you already know by now, if you were to exercise this call option, it just means that you're going to take the max loss of this width, which you have no reason to, right? There's no reason for you to go and take the max loss of this call option. So instead, we also want to use the same 3 steps. So in this case, the 3 steps will be this. So first of all, you buy back the 100 shares. Right? When you buy back the 100 shares, you have no positions. Now you want to sell the original short call strike price again at the same strike price and at the same DTE, just to re-establish the same Iron Condor which you have first initiated, right? Now step 3 is basically the same as step 1 and step 2. right? You put these two steps together, you do it in a single order ticket, and you will be able to get this, right? So this way, again, no legging risk. All right, so what do you do after you have unwinded your assignment? Again, same thing as the put side, you are still not out of the woods, right? You could get early assigned on your short call again, and that's not what we want. So similarly, there are two options, right? The first option is to simply just close out the spread for a loss and then wait for another opportunity. The second option is if you still feel that, you want to hold on to this iron condor and you think that the market can actually just retrace back down into your profit zone, then what you could do is this. So first of all, you roll the entire call spread out to a further DTE. So the same thing as what we did with the put spread side assignment. So you roll out to a further DTE, and then for your put spread side, same thing. What you want to do is you want to roll it up this time closer to the market and then roll out to a further DTE as well. And basically the DTE for the call spread and the put spread, you now want it to be the same. So this way, now you have a longer dated iron condor, although now you will have a slightly tighter max profit zone, right? Let's say, for example, if you were to roll to this point down here, so maybe previously it was 100, you roll the put spread up, maybe now it's 110. So now you have a slightly tighter iron condor, but what you have done is that you have actually extended the life of this iron condor, right, in hopes that if the market comes back down, you can still profit from this iron condor. Now let's talk about how to reduce the risk of early assignment. So although now you already know how to reverse any assignments that you have, well, as the saying goes, prevention is always better than cure, right? It's best to avoid any assignment in the first place. So how do you do that? Well, the very first method, right, would just simply be to exit at 21 DTE when either of your short legs is in the money. And we only want to do that, right, when it's around 21 DTE. So let's say, for example, your short call strike has been breached, but there's still like 30 DTEs on it. So at this point, do you exit? No, you don't have to exit because the chances of you getting early assigned is not that high, right? Unless, of course, your call strike is really deep in the money and also maybe the underlying is paying out a dividend where the dividend is more than the extrinsic value, then yes, right, you can consider actually just exiting the whole spread so you don't get assigned. But for the most part, the chances of you getting assigned is going to be low, especially also if you're going to trade the index ETFs. On top of that, if you were to exit at 21 DTE, you can see that the performance is actually much more superior than if you were to hold to expiration. So just from this graph alone, you can see that there's no need for you to actually hold all the way to expiration, right? So this is a study done by the Tasty Trade team, and I've shown this many times before in my other videos. So it should be drilled into you right now that, if you want things to be safe, you want to have a superior performance, you don't want to get any early assignment, then just exit at 21 DTE, keep things very simple. Now the next would be just to trade the cash settled index options, right? So cash settled index options are basically European style options. European style options are options where there is no chance of early assignment. That means the buyer of the long options can only exercise during expiration. So in this case, there's no risk of early assignment. You can just trade this index options, cash settled index options, and there are a few, right? You have the SPX, XSP, NDX, the RUD, MRUD, OEX, and so on and so forth. Okay, so this is the Iron Condor assignment reversal strategy. So there's no need for you to panic anymore, no need to get nervous, even though any of your short strikes are in the money, because now even though if you are assigned, you now know how to unwind any assignment that you have. So what I'm going to do is that I'm going to show you the trade, then I'm going to present you the different scenarios. Then for each of the scenario, I'll be giving you 3 of these options, right? Basically to hold, roll, or close. Then I want you to decide which is the one that you will go for. After that, I will give you my answer as well. All right, so let's get into this. So here is the trade, right? The trade is a $5 white Iron Condor with the strike price at 160, 165. So this is for the put spread side, as you can see down here. And then you have the call spread side, which is 185, 190. You combine this two, you have the Iron Condor. And this is a 45 DTE trade, and we sold it for $1.50, right? So this is the credit that you will receive. So here's a question for you. If this is a $5 white Iron Condor and you receive the credit is $1.50, then what is the risk? So if you don't already know how to calculate this, it's very simple actually. Basically what you do is you take the width of the spread. So in this case, it's $5, and you minus off the credit which you receive, and that is $1.50. So what is the remainder? The remainder is $3.50. So $3.50 is the max risk that you can incur on this very trade, right? So for a single contract, that will be $350 in terms of risk. Okay, so now let's move on to the first scenario, and that is, what if the market stays inside of your short legs and your iron condor is now $1.10 and there's 30 DTE left to go? So do you hold, do you roll, or do you close? So take a moment to think of your answer, and then I'll give you mine. All right, first of all, if your iron condor is now worth $1.10 and you sold it for $1.50, what is your P&L now? Are you in profit or are you in a loss? Well, the answer is that you're in a profit because we sold at $1.50. So for us to make money, we have to buy back at a lower price than this $1.50, right? So for example, if you close out this trade right now, it will be for $1.10. That means your profit will be 40 cents, right? Which translates to $40. Okay, so what is the answer? So my answer is that I would hold on to this trade. And the answer is because that there's still a lot of time left, and it's also not yet at 50% profit, right? 50% profit will be roughly at 75 cents. So there's also no point to roll. So as you can see down here, I've canceled out rolling because your trade is in a profit, right? So it's working out well. So generally, there's no need for us to roll if your trade is not in a pickle, right? Basically, your trade is not being tested or it's not in a loss. There's no need for you to roll. All right. As for closing, you can actually close this if you think that you've already gotten enough out of the trade, right? You think that, you know, 40 bucks is good enough because you already made 40 bucks in what, 15 days, right? And let's say, for example, you have a new trade opportunity that you want to get into. So what you can do is that you can close out this, right? Free up your buying power to redeploy into the other trade, right? So this is something that you can do as well, right? But my preference again would be to hold. So scenario number 2, so this time it's the same as well, where the market is staying inside of your short legs and your iron condor is now worth 75 cents and there's 30 DTE left to go. So in this case, you've already hit 50% of your profit, right? You've already made about $75 in 15 days. There's still 30 days left to go. So do you hold, do you roll, or do you close? So in this case, I think there are two answers that's perfectly fine, right? You can either hold or you can either close. So for me, I would choose to hold because there's still days left to 21 DTE, but you can definitely still close it because, you know, you've already reached 50% of the profit, right? So why do I say, you know, I want to hold on to it rather than close it, right? So as you can see down here, I brought up this table down here, which is a study that is done by the Tasty Trade research team. So what they've done is that they did a lot of research on this 20 Delta $5 white iron condor, right? So they tested it based on different exits. So they have the exit based on, you know, holding it to expiration, exiting at 50%, right, when there's 50% profit, and exiting at 21 DTE. So as you can see, this is the result down here based on the daily P&L, that if you hold to expiration, your daily P&L is going to be the worst, right? The second is 50% winner, and 21 DTE is the highest. So basically, you have the best result if you exit at 21 DTE. So that is why, you know, I choose to exit at 21 DTE rather than just get out at 50%. Now, there's a caveat to that. That means to say, let's say instead of one contract, you actually trade two contracts. Basically, you have two iron condors. So in this case, you can actually take off one at 50% profit, and then the second contract, you can actually leave it to 21 DTE before you exit it, right? So this way, you have more choice. You have both of them, and then you can control your volatility better. And the reason I say this is because, let's say, for example, you close out at 50% profit, right, for the first contract. Now, what if the market suddenly makes a big move to either of your strikes, either the call side or the put side, and then all of a sudden that now becomes a loss? So the good thing is that the first contract, you close out at 50% profit. So that is going to, you know, negate quite a bit of the losses that you sustain on the second contract. So in this case, what you're doing is that you're really managing your P&L volatility. Now, of course, there's still a chance that, you know, when you exit at 21 DTE, the profit is going to be even bigger than exiting at 50% profit, right? So in this way, at least you ensure that your P&L will be kind of pretty smooth rather than, you know, have one big upswing or downswing either way. All right, so again, either 50% or 21 DTE, and I wouldn't exit at expiration, right? There are still quite a bit of risk exposed, which I'll share with you later on. And as for rolling, right, I wouldn't say there's any reason to roll at all because the trade is in a profit. Scenario number 3. So for this, the market also still is inside of your short legs, and your iron condor is now worth 90 cents. And there's 21 DTE left to go. So what do you do for this? So in this case, you probably only make 60 cents, $60. So it's slightly a bit off from your 50% take profit, but there's still some profit, and there's 21 DTE left to go. So what do? Right? Do you hold, roll, or close? So for me, my answer is that I would close, because again, studies have already shown that when you exit at 21 DTE, you will get a better result over the long term than holding to expiration, right? So as you can see down here, this is the study done by the Tasty Treat team again. The research team have shown that when you exit at 21 DTE, your results is going to be much more better. It's going to be superior than if you were to hold to expiration. Again, you know, when we are entering into trades, especially option trades, we want to lean a lot onto studies, right, on statistics and probabilities, because options tradings is very backed heavily by numbers, right? So if there's already the research done, the studies have already done, and as you can see down here, these studies have been dated all the way back to before 2007, right? This is even before the financial crisis in 2008, and the study has, you know, been for more than a decade, right? Even past 2017 to 2018. So you can know that the studies that they have down here is very statistically relevant. So that is why I would just close off the trade, because it's already hit, you know, 21 DTE. Now, as for rolling, there's no need to roll again because you're in profit. Now, as for holding on to the trade, I've actually got quite a few people that have reached out to me, and you know, they ask, right? They say that the short strikes, the short legs have not been tested, and it's still well within the profit zone of the iron condor. Can they still hold on to the trade? So in this case, my answer is that yes, you could if you want to, but you need to be aware that while the market could still stay within your short legs, which is the profit zone, and can increase your profits, the market could also easily make a big move and turn the trade into a loss, right? So let me just remove all the drawings down here. So let's say, for example, right now, the market could be at this point, right? And maybe at this point, you are in profit, right? 21 DTE left, and there's 90 cents left. Now, if the market continues to stay there, right, towards, you know, the expiration, then yes, you're going to be making much more, right? Because all the extrinsic value will start to erode as it gets closer to expiration. But on the flip side, you also have to be aware that the market could still easily make a big move, right? Because what if the market goes all the way down? So at the point of time, you could have secured a profit, but instead you wanted to hold on to it, and now the market has went down and now it became a loss, right? So this is something that you need to take into account and just be aware. Scenario number 4. So now the market has went down and is near one of your short legs, and your iron condor is now worth $2, and there's 30 DTE left to go. So at this point, you notice now you are losing money, right? So in this case, you're losing $50. So at this point, do you hold, roll, or close? So my answer is that I would still hold on to the trade, because my short leg has still not been breached and the market could bounce back up. Again, by the way, this is just for the put spread side. So if the market actually goes up to the call side, then it will be the opposite, right? So it's pretty much just the mirror of this. So for rolling, you could choose to roll the call spread down. So let me just remove this drawing. So you could actually just choose to roll the call spread down to get some credit to cushion the loss if the market continues to go down. But then again, you need to be aware that there is the possibility that you can get whipsawed if the market suddenly bounce back up. So some people have asked me before, they want to always reposition their deltas every few days or weeks. Basically, they just want to get to as delta neutral as possible. So generally, the idea down here is that if the market, you know, moves away from its central point and it moves closer towards one side of the legs, what they will do is that they will roll down the untested side to kind of neutralize the delta. And the thing with this is that you can do that. However, you may get whipsawed, because remember, when the market goes down, it's still going to be pretty near where you're going to roll this call spread to, right? Let's say, for example, you roll the call spread down to here. So now your new call spread will be over here. So at this point of time, it's still pretty close, right? The market could just go back up, and then now what are you going to do? Are you going to roll this put spread up, and then it's going to start to reduce the profit zone? So one thing is that when we roll, of course, we're going to narrow our profit zone, right? And I mentioned this before. So the key down here is I don't want to narrow the profit zone too quickly, right? Too soon. I only want to wait until either of my strikes get breached, either of my short legs get breached before I roll the untested side down, right? It's almost like something like an emergency fund, right? You do not want to tap into your emergency fund unless there's an emergency. So in this case for Iron Condor, right, I wouldn't say it's an emergency, but rather when it actually tests our short strikes, that's the time when I would consider rolling, because at that point of time, the market is really pretty far away from the other side, right? So let's say if the market goes all the way down here, right now the call spread is very far away from where the current market price is. So when I roll it down, at least, right, it's not going to be so near compared to at this point that it can easily, get tested again if the market just suddenly shoots up. All right, so this is just my thoughts about this. You can choose to follow it if you want to, or you can, if you want to have your own way of rolling or your own way of thinking, yeah, by all means go ahead and apply that as well. Now as for closing, I wouldn't consider closing because there's still time left for the trade to work out. Scenario number 5. So right now the market is near one of your short legs, and the same thing as well as scenario 4. Your Iron Condor is now worth $2, but this time there is 21 DTE left to go. So what do? Do you hold, do you roll, or do you close? So for me, my answer is that I would just close the trade again to adhere to exiting at 21 DTE, because again, studies have shown that when you exit at 21 DTE, your long-term performance is going to be better than if you just hold all the way to expiration. Now, what about holding and rolling? So as you can see down here, I've already put it in the orange box because they are possible choices for you to go for. But if you want to hold to expiration or until the trade is back in profit, then you want to be aware of the possible risk. Like I mentioned before, the trade could go further against you, right? It could go further down, and then now you incur an even bigger loss when you could have gotten out at a smaller loss. And alternatively, you could also choose to roll out the whole spread if you can get a credit, right? Basically, you roll the call spread and the put spread out to a further DTE, and then you get a credit. And when you get a credit, basically you're prolonging the trade. In case the trade might work out in your favor, the market goes back up. All right, let me just remove this. So in case the market goes back up, then your trade will now be in a profit, right? But one thing to understand is that this rolled trade, right, is basically just putting on a new position, because when you roll it out, what you're doing is that you're just closing the existing trade and then putting on the new one. So when you put on this rolled new trade, so to speak, it will actually have a lesser probability of profit than the initial trade, right? Because when you put on the initial trade, your wings, or rather your short legs, are on the opposite end of where the current price is. But right now, because it's very close to one side of your strikes, what you're doing is that you are starting off this new Iron Condor, this rolled Iron Condor, at a lower probability of profit, because right now the market is very easy for it to just breach the short side, right? You can just very easily just go down and then breach the short put side. So that's why your probability of profit is actually lower than the initial one. Now, scenario number 6, the market has breached one of your short legs and your Iron Condor is now worth $2.50. So right now you are losing about $100, and there's still 30 DTE left to go. So right now the market may have just breached your short put, or it may have gone even further down where it went past, your long put strike, right? So what do? Do you hold, do you roll, or do you close? Well, for me, my answer is that I would roll down my call spread to get more credit to cushion the loss, and I generally won't roll only until either of my short legs get breached. As for closing the trade, I rule that out because it's not near the 21 DTE yet. And the final scenario, so scenario number 7, the market has breached one of your short legs and your Iron Condor is now at $2.50. So the same as scenario number 6, the difference is now there's 21 DTE left to go. So what do? Do you hold, roll, or close? So I'm pretty sure that you already know my answer by now, and that is that I would just close the trade out for a loss. And the reason is because it's already at 21 DTE. So it's not possible to avoid losses. That's one thing to understand. I've had even people emailing me, asking me, how can they put on trades and not have a single loser? Every trade they want is to be a winner. Unfortunately, there is no possible way. If you do find a way over 1,000, 2,000 trades, then please contact me. I'd like to know as well. But for the most part, if you were to just take a look at probabilities by itself, you know that it's impossible, right? Because when you put on an iron condor trade, the probability of profit will be roughly around 65% win rate, 70% win rate, just based on the theoretical probability. And this is roughly around 20 deltas for the short legs. So what that also means is that there is still a 30% chance, right? 35% chance even, that you could lose on your trade. So this is one thing that you need to understand. So when there's a loser at 21 DTE, I'm just going to close it out. So if you choose to hold and you don't want to close the trade and you don't want to take the loss, then you need to understand the potential risk in doing so. So first of all, yes, the market could come back up, right? Let's say, for example, you went all the way down here, the market could certainly go back up, and then now you're in a profit, and suddenly you're like a genius, right? Because you held on to the trade. But then again, you need to understand that the market could possibly go the opposite direction, right? It could go further down and then you increase your losses. At the same time, don't forget that there is an early assignment risk. When you get assigned on a short put, there will be long 100 shares of the underlying. If you're exercised or assigned on your short call, then there will be 100 shares that you're short at that position, right? And this could lead to a margin call if you don't have the funds. So the risk is pretty big down there. So that is why I do not like to generally hold past 21 DTE. So as you can see down here, again, this is the same graph I showed earlier. So although you can see that 21 DTE is a profit, you notice that there are bumps along the way, right? You can see that the market has actually dipped down quite some time before going back up and then dip down again. So as you can see somewhere around this timeline down here after 2017, you see there's a big drop, right? There's a big drop, but then after that, the market starts to recover again and then come back down a little bit. And basically, it's just going to go back and forth until eventually it goes back up again. So the losses are there, but that doesn't mean that you won't be profitable in the long term, right? Again, as long as you stick to the mechanics and you manage your risk well, then in the long term, you will definitely have a good chance to be profitable. And finally, rolling is also possible if you can get a credit, but understand that the roll trade again would have a lower pop than the original trade. Moving on to question 3 is by Donald Phelps. So his question is, Davis, how often do you adjust your delta neutral positions to get back to neutral after a move in the underlying? For example, if you had a 60-day iron condor, would you roll a wing after a week, 2 weeks, 10 days, etc.? So Donald, this is a very good question. So what Donald here is saying is regarding, maintaining a delta neutral position, which is delta close to 0, right? So let's say, for example, you put on an iron condor, right? So this is the iron condor position. So let's say, for example, when you first put on the position, it's somewhere around 0 deltas, right? Let's just assume that it's at 0 delta. Now, let's say after some time, let's say, for example, a week, the market starts to move and now it has come down slightly from where you've put on the position at first, and maybe right now it's showing something like 20 deltas already. So at this point, you're no longer delta neutral because it's no longer at 0. So what Donald is suggesting is that, you can just adjust one of your wings. For example, you could bring down your call spread down and then making this a little bit more delta neutral, because when you bring this down, you bring in more bearish delta. So right now your 20 deltas could now become somewhere around 5 deltas after you have rolled your this call spread down. So the question is, how often do I do that? So for me personally, I generally don't roll unless either of my short strikes get tested. And the reason is because I don't want to reduce the profit zone of my iron condor as much as possible and potentially get whipsawed, right? So for example, again, this is the iron condor construct. So let's say, for example, the market comes down here, and assuming you want to make it to delta neutral. So to make it delta neutral, generally what you would do is to roll this call spread down. So when you roll it down right now, your strikes are going to be much closer to where the current market price is. And I don't really like this, mainly again because you are reducing the profit zone. So you notice previously this was your profit zone. It's much wider, right? But because you want to have a delta neutral position, when you roll down this iron condor as the market goes down, what happens now is that you have a smaller profit zone. So imagine this, if you keep doing this over and over again, as long, imagine if the market keeps going down again and you keep shifting your call spread down, your spread, or rather the profit zone, is going to get tighter and tighter to the point whereby, you could get easily whipsawed as well. Because what if the market suddenly rebounded? If the market rebounded, then what would you do, right? Would you move up the put spread then? If you move up the put spread then, just to get a delta neutral, in the end, it's going to be so tight that you can hardly even profit. Yes, you kind of mitigate the risk a little bit, but then also it makes it very difficult for you to profit. So that is why for me, I will basically just roll it, the untested side, only once either side has been tested, right? But if you want to be aggressive with managing your positions, then yes, you could. And you want to fix it at X days or weeks. So again, there is no fixed rule, hard and fast rule that it has to be a fixed certain number of days. This is something that is up to you. All right, question 4 is by Bernard Boyd and JS. So basically they both have a question respectively, which is pretty much the same. So that is why I want to put them in this question. So the question is, for $100,000 account, given the current market, how much would you allocate to a put credit spread strategy, an iron condor strategy, and a negative delta strategy? Which one, and cash? And the other question is, if I have a small account of $10,000, I got from your videos that I should risk maximum 5% per trade. That said, how much of the total account should I allocate to be in trades? How much should I keep in cash? So again, very good questions. So this question has got to do with capital allocation. All right, so my answer is that for each strategy, you should allocate based on your capital allocation per trade, roughly 1 to 5%, right? The max being 5 to 7%, right, on any single trade. Now, how much should you actually allocate in total for your portfolio? Then this is where you want to use this table as a guideline, right? So as you can see down here, if the VIX is low, roughly 10 to 15, then you should have a max of 25% of your total capital being allocated, which means at this point you have 75% in cash, right? So I'm just put somewhere down here where you say cash. And on the other hand, if the volatility is very high, then the maximum allocation you want to put into trades with 50%, which also means that you want to leave 50% in cash. All right, so basically you want to still leave aside sufficient cash so that whenever there is a drawdown, or when your position have multiple losers in a row, where it's not uncommon, then at least you still have some cash to fight back in the long run. So again, remember, this is a game for the long term. You don't want to risk so big that you could lose everything just in a number of trades, right? So again, you want to adhere to proper risk management and follow this table in terms of the capital allocation. Now, question 5 is by Alex Tree. So Alex says, "Hi Davis, good morning to you from Malaysia. I've been thinking, if someone dealing with short strangle with unlimited risk, was there in any history of time the stocks can jump exponentially and exceed either the call or put side and cause a huge loss? Besides using spread and turn short strangle to short iron condor, any way to prevent such a risk?" I hope you can understand what I'm trying to say, because even if I use good pop win rate, there will be certain percentage I'll be surprised with huge loss, which I intended not to experience it. It's too costly lessons to pay. So Alex, this is a very good question, and I definitely understand what you're trying to say. So I want to share with you some data and statistics that is done by the Tasty Trade team. So whenever we want to talk about losses and performance and risk as well as win rate, we always want to lean on statistics rather than what we think, right? Because we want to be objective rather than subjective. So down here, as you can see, this is a study done by the Tasty Trade team on the 1 standard deviation strangle. Now, they have already boxed out to show you how the strangle will actually perform when the market crashed in 2008. So as you can see, in 2008, there has been a very big move, and it went way past, of course, the put side, and that's where you have losses. So one thing to understand is that it's not really possible to prevent such a risk totally, right? Because you will still be hit, because nobody knows when the crash is going to come, right? And when it comes, you just need to know that over time, as you can see down here, over time from this point all the way to here, in the end, the market did recover, and then you are still in profit again. All right, so again, first thing to understand is that while you may still take losses, over the long run, you can still be profitable. Now, I'm going to show you another data right now, which is even more interesting, because now it comes to risk. Because down here, we see that, hey, it's very scary, right? You see that the market, when it crashed, your strangle also lost a lot. but how much do you exactly lose? So this is not something that is like a question mark that you have no idea how much you're going to lose. In fact, you can know how much you're going to lose, and you can be prepared upfront for that. So here is a table to show you, right, at expiration, what is the probability of loss exceeding the BPR, and what is the max loss when you actually have this loss. What's the max loss as a multiple of BPR on the right hand side of this column, right? So BPR basically stands for buying power reduction. And what it means is basically it's just the collateral or the capital that's being tied up for putting up the position, right? So let's say, for example, if you put up a position and the BPR, it says it's $2,000, and that means that $2,000 will be held by the broker to put on that strangle trade. All right, so let's just say that, you know, the BPR is $2,000. Okay, so down here you can see that these are all the different underlyings. Now let's take a look at two specific underlyings. So first, let's take a look at SPY. As you can see, SPY is an index ETF. So the probability of loss exceeding the BPR, that means this amount when you first put on, is actually 0.9%, which is less than 1%. So that means the chances of you actually losing more than this $2,000 is only 1%, right? Less than 1%. Now the question is, how much exactly do you lose? So down here, you can see down here, it says 1.6 times. So basically it's 1.6 times of $2,000. So that is roughly $3,200, right? So you already know that there'll be 1% of the time that you're going to lose roughly $3,200 as the max risk. Okay, so this is for SPY. Now let's take a look at Amazon. Now Amazon is 2.6 times the probability of loss. So now you have a higher chance of losing more than, you know, this BPR they put up for the trade. And how much more? As you can see down here, it says 3.1x, which means to say it's more than $6,000 on Amazon. So you can see down here, right, for SPY, let's say, for example, if the BPR is $2,000, then the max loss you're going to have is 3.2K, and it's less than 1% of the time that's going to happen. But if you're going to put on individual stocks, like for example, Amazon, then it's going to happen much more often, 2.6%, and your risk is going to be much more when you lose that amount. So what's the moral of the story down here? Basically, stick with index ETFs if you want to trade strangle. Now here's another more important finding, and that is, what if you exit at 21 DTE instead? Now you notice that if you exit at 21 DTE instead, all of a sudden for SPY, the probability of loss exceeding your BPR is actually now 0%. That means, let's say for example, if the BPR is $2,000 again, it means to say at no point will you actually lose $2,000 or more. So you already know what is going to be the max risk when you put on this strangle, right? Even though there's going to be a crash, you know that this $2,000 is not going to exceed it, because based on the statistic, you're not actually going to, you know, hit this BPR. In fact, how much are you going to hit? It says only 0.6 times. Right, so that is much lesser than $2,000. That's about $1,200. So from here, if you exit at 21 DTE, you already have reduced your risk significantly. Now, as for Amazon, as you can see down here, the risk has been reduced significantly as well, from 2.6% to 1.1%. But then again, you know, there's still, you know, a pretty big risk, because also you notice what is the max loss. It's 2.8x, which means to say, you know, it's close to $6,000 still in terms of your loss. So again, you cannot prevent such risk, but how do you mitigate or reduce the risk? And that is by going with index ETFs, and as well as exiting at 21 DTE. Now, I want to share with you another study, and this time this is on iron condors. Now, I know you did not really specifically talk about iron condors, but I want to share with this, you know, with the rest of the folks who are interested in trading iron condors. So iron condors is very similar as well. So as you can see down here, let's say for example, your long wing delta, that means to say this is where you buy the options, right? Either the buying the call option or buying the put option as the protection, right? So this is the wing part. So this is for 13 delta. And they do it all the way to 5 delta. So if you were to exit at expiration, you notice that the probability of actually hitting the max loss on your iron condor is 6.4% for 13 delta wing, and 5 delta wing is 1.2%. So basically, if your wing is pretty wide, the chances of you, you know, hitting that max loss is pretty low. Now here's the cool part. What if you exit at 21 DTE? If you exit at 21 DTE, you notice that everything has been reduced to under 1%. So here again, the moral of the story is, exit at 21 DTE, and that will help you reduce your risk. Question number 6 is by John Nickel, and John Nickel says, if I have a iron condor on and the price drops close or past credit put strike, would it make sense to buy back call spread if it reaches 50 or 75% of call side combined premium received? And same thing in reverse, if price reaches credit call strike. All right, so this is a very good question, right? So basically what John is saying is this, right? Let's say, for example, the market has gone, all the way down here, right? So let's say it has gone past your put strike down here, your put spread down here. Should you just close out this call spread and leave this put spread on? If most of the profit, I think 50 or 75% of the call side combined premium has been received? Well, basically the answer is yes, you can do that, right? If you are very confident the fact that the market can actually bounce back up, then you can do that, right? You'll be making on both sides because you already took off the call spread for a profit, and then as the market bounces back up, your put spread will be out of the money, and then you can close this as well, and then you have made on both sides. Now the downside to this strategy is that what if the market actually continues to go down instead of going up? Right? And because this time you have already closed off your call credit spread, this call credit spread cannot help further mitigate the losses that you sustain on the downside. Because if you have kept this spread on, then there's still some credit left whereby you will still be making on this position, right? Maybe if you close off at roughly 50%, there's still another 50% that you can still take out of this call spread as the market goes down, and basically this whole position will not lose as much. Okay, so this is the drawdown of this method. So that is why I prefer to actually just keep it on as a package and take it off as a package. So unless you're good at technical analysis and you think that the market is really going to turn, then you can take it off, right? You can take off the call spread. But otherwise, I would just leave it on and just close out everything as a whole. Okay, question 7 is by Enrico Saccagiani. I hope I pronounced your last name correctly. If I haven't, please forgive me. Right, so Enrico says, hi Davis, I prepared several programs to check for potential assignment risk. I assume that if there are fewer than 21 days until expiration and the extrinsic value is less than 50 cents, it is better to close the position. Some argue that the danger only occurs in the last week, but I was assigned as 14 days to expiration. I believe there's no sure way to avoid assignment. Theoretically, every short option can be assigned. The folks at Tasty Trade suggest rolling the position at 21 DTE. However, I think it might be better to let the extrinsic value decrease and maintain the position, especially if the option is at the money or out of the money. What are your thoughts? So Enrico, this is a very, very good question. And this question has got to do with assignments. All right, so here's my answer. Firstly, you are right. And as mentioned in many of my assignment videos on my channel, the biggest risk of early assignment is when your extrinsic value is very little, right? So it does not really have that much to do with the time left, because if you have very little extrinsic value, let's say for example, you only have 10 cents left in extrinsic value on your short option, but there is still 100 or more days left in the option lifespan, guess what? Then you can still get assigned, right? Because there's no longer any incentive for the option buyer to hold on to the trade. And second thing is, yes, there's no sure way to avoid assignment, but you can reduce the risk of early assignment. So that is why the Tasty Trade actually suggested to roll at 21 DTE, because over the long run, 21 DTE still get a better performance, as I showed, in the earlier slides. And at the same time, most of the time at 21 DTE, there should be some extrinsic value left, so that, the chances of getting early assigned is not that high. But again, it really depends on how deep in the money that short option is. If it's very deep in the money, then again, no matter how long the time is and there's very little extrinsic value, you're still going to get assigned. Now, secondly, as for holding past 21 DTE, if it's out of the money or at the money, yes, you could do that, right? Because I can certainly understand where you're coming from. Because after all, your spread could be still out of the money, right? So there's no real reason to panic, and you can just let the extrinsic value, just decay slowly over time. But the bigger question and more important question you have to ask is, whether does it actually give you a better long-term result? So again, as you can see down here, these are the statistics study already done by the Tasty Trade team, right, for spreads as well for iron condors. You can see that 21 DTE is much more superior in the performance than holding all the way to expiration. So if you really want to still hold on to this position past 21 DTE because it's out of the money or it's at the money, then what I would suggest is to actually run empirical tests to actually compare your theory so that it is actually objective. And by objective, I mean it's actually based on statistics, right? Solid statistics that you can look at and say that, hey, objectively, this is better than exiting at 21 DTE. And you want to do it over at least 100 plus trades, right? You want to do it over 100 or even more trades, even better, because the more sample size that you have, then the more accurate the results is going to be. Now, this is much better than, being subjective where you think it's better, right? Because a lot of people can just say, I think it's better to just, hold on to it because it's out of money. But at the end of the day, the best thing you want to do is always have tests and back it up with statistics. So again, you'll be objective rather than be subjective. Now, the last and final question is by Brent Cole, and his question is knowing what strategy to use and when. For example, I have an iron condor trade on for SPY, market neutral. It started at 45 DTE. It is now at 29 DTE and the market has fallen. I can't roll the trade for a credit, but there are other trades I can put on that help offset the loss if the iron condor ends up losing, but I don't know what trades I would put on in succession of the iron condor to protect against market swings up or down. So Brent, this is also a very good question and a pretty loaded one, right? So there are many facets to this. So first of all, I would say just watch the video which I have on my channel. It's called The Ultimate Guide to Option Strategy Selection. Basically, this will answer the first part of your question of knowing what strategy to use and when. So in this video, I go in depth into the strategies that would be suitable for you based on your account size as well as your experience and when to put them on, right? So go and watch that video. Now, for the second part of your question, you talked about the iron condor, right? Where you mentioned that you cannot roll for a credit because the market has fallen. So here's the thing. As the market falls down and tests the put side, you actually can roll for a credit. And it's not to roll out, but rather it is to roll the call spread side down. Because when you roll the call spread side down closer to the market, you can get a credit for this iron condor. So when you roll it down, basically it will be looking like this. Now you have a tighter spread, of course, but what you have done is that you have kind of mitigated a little bit of the risk to the downside, right? Because you've collected a little bit more credit, and as long as you keep the width, the spread width the same for the call spread as you shift it down, then your overall risk is going to reduce as well by the amount of credit you receive. Okay, so you can actually just roll it down for a credit, but one thing you need to understand as well, as I mentioned in the earlier slide, if you were to roll it down, you'll be reducing the max profit zone, but it's definitely fine as well, because by then, at least if the market continues to go down, you have reduced your risk on the downside. The very first step is to build your watch list, right? So your watch list would normally consist of index ETFs and individual stocks. Now, when it comes to trading iron condors, my preferred approach would be to trade the index ETFs. So if you were to take a look down here, this is a graph down here that shows, the movements between the ETFs and the stocks. So as you can see down here, ETFs is this color, light blue, whereas the stocks is more towards the orangey yellow color, right? So as you can see down here, what this graph is really showing you is that the range down here of the ETFs is usually much more concentrated, more tighter towards the center part, whereas the stocks wise, right, as you can see, their range is much bigger, right? So when we are trading iron condors, what you need to understand is that this is a strategy that seeks to profit when the market stays within a certain range, right? Because we have a call spread at the top and we have a put spread at the bottom. So let me just draw out this iron condor structure down here. So as you can see down here, this is the iron condor structure. You have the put spread at the bottom and you have the call spread at the top. So as the market comes down here, what it's trying to aim to profit is from this range down here in the middle, right? This is where we're going to make the profits. So when you're trading iron condors, we generally want an underlying that stays in a very narrow range most of the time, right? So if you were to compare index ETFs and individual stocks, index ETFs would actually be the better underlying to trade, a better vehicle to trade, mainly because it's not as volatile as stocks, right? Individual stocks are much more volatile. True, you get much more premium, but that's also because there's much more risk, so to speak, in terms of the movement of the underlying stocks, right? Stocks, because it's just a single stock, one big news, right, can really move the stock in one direction or the other, and that can easily breach, one of the sides of your iron condors, right? May breach the wings of your iron condors, which is not what we want. Whereas index ETFs, especially the broad-based index ETFs, where they consist of, many different underlyings inside of the index ETFs, the chances of it, making such a big move based on one stock's news is not as huge as compared to the underlying, or rather a single stock. So that is why for iron condors, if you want to have a better chance of winning the trade, then you would want to go for the index ETFs. Now, step number 2, once you've already built a watch list of your index ETFs and individual stocks, right, preferably most of them are index ETFs, this is where you want to go through your charts, right, the charts of each of the underlyings that you have on your watch list, and you want to identify the previous highs and lows. So this is what you do. You can go through every single chart, and then you take a look at where the price is. So let's say, for example, down here, you can see on the chart, the price is somewhere around here, right? This is where the current price is. So what you want to do is find the previous high and then the previous low, and then you draw these lines across, right? So as you can see down here, these are the lines that kind of depicts the range of where you can build your iron condor, right? So if the current market price is inside of the previous highs and lows, this will be the underlying to place an iron condor on. And preferably where we want to have our strikes would be outside of this previous low and previous high, right? So again, let me just draw out, this is -1 +1. So this is for the call side. Again, now here, this will be -1 and +1 on the put side. So the main reason why we want to identify this highs and lows is that in the event whereby, the price do actually trade up, or maybe it trades all the way down and it hits one of these previous highs and lows, it actually serves as a kind of a support resistance, right? Where the market could come back up again if it bounces off this support, and it could come back down again, right, if it bounces off this resistance. So making it a likelier chance, a likelihood that the market will stay within your iron condor range as you trade it. Now, step number 3, once you've already identified what is the underlying that you want to trade on, the next step would be to identify the DTE you want to use, right? So DTE is basically the expiration dates, and generally we want around the 45 DTE mark to have a long-term statistical edge, right? So as you can see down here, this is the option chain. So as you can see, you are faced with quite a number of expiration dates to choose from. And one of the things is that many people like to go for the shorter term, right? They like to go for maybe 0 DTE, or maybe they like to go for the 7 DTE ones, or maybe some would go for 14 DTE, which is 2 weeks. And the reason why most people want to go for this shorter term trades, this shorter term DTE, is because they want to realize the profit fast, right? Because if 0 DTE just means that at the end of the day, you are able to realize a profit or a loss, right? They want a quick reinforcements of, whether you're going to be making money or losing money. Now, why do I say that we want to go for the 45 DTE mark instead of those, at a very shorter term DTE? Well, the main reason we want to go for roughly around the 45 DTE mark is because of this statistical edge. So the main reason why we want to stick to around the 45 DTE mark is because this is the only time where the expected move is bigger than the realized move. So our edge when we are trading iron condors come in the fact that the realized move would be smaller than the expected move, right? So as you can see down here, if we go for the 45 days DTE, you can see that the expected move is bigger than the realized move, which means to say the realized move, the actual move in the market, is smaller than the theoretical range by the mathematical model by which they price options. That is why we want to go for the DTE, whereby the realized move is actually lesser than the expected move. But if you were to take a look at the days that is lesser than 45 DTE, you notice that the expected move is actually not bigger than the realized move, right? As you can see, no, 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 and no. So it's all no for anything under 45 days, right? You can see the expected move, which is basically the expected range for the 7-day one, is roughly 2.1%. Right, but the realized move is 2.2%, which means to say it's actually moving bigger than the realized move. So when we place our strikes, we want to place our strikes roughly around the expected move range, right? So let's say, for example, this is the expected range down here. So what we want to do is we will want to place our strikes somewhere around here, right? So you will place your short strikes here. So this will be where your iron condor call spread is, and this is where your iron condor put spread is. right? So we want to put it around where the expected range is. But this is telling us that, at 7 days, the realized move is actually bigger than the expected move, which means to say that when the market actually moves, it could move past where our range are, right? Is where we place our short strikes at, which means to say we are not going to make money on the Iron Condor. We want to choose the DTE, whereby the range actually stays inside of this move down here, right? Inside of where we chose our Iron Condor strikes. And this can only happen if we choose the DTE, whereby the realized move is lesser than the expected move, which is why we want to choose 45 DTE. Now, step number 4. Once you've already identified the DTE that you want to choose to trade the Iron Condor on, the next step is to identify your short leg strike price around the expected move based on delta. So as a general rule of thumb, is the lower the delta that you choose for your short strikes for your Iron Condor, right, the more conservative it is, because you will have a larger profit zone, and the higher delta it is, slightly more aggressive, but of course you get more premium as well. So it is just a trade-off. There is no one that is better than the other. It comes down to, which one you feel more comfortable with. So as you can see on the left hand side down here, this is the option chain, but as you can see, it's pretty small. So let me just increase the size down here so you can see it a little bit more clearly. So when you open up the option chain, you'll notice that you have the calls on the left hand side and you have the puts on the right hand side. So this is where you want to start to construct your Iron Condor. So the first thing we want to do is to select our short strikes, right? That means we want to choose the short put strike and the short call strike. So how do you want to go about doing that? And that is by choosing the delta that is around the expected move, right? So that will be the range of roughly 16 to 20 delta. So this is where we would want to place our Iron Condor short strikes at. Now you might be wondering, why is it roughly 16 to 20 delta? Well, the answer is because this is where the expected move is roughly around, right? So as you can see, this is another study done by the Tasty Trade team. You can see over here, it says one side, it says based on expected move formula. The other side, it says based on 16 delta options. So the one that is based on expected move formula, it will show on your option chain on the top right hand side, by the way, right? I don't show it here mainly because, right, if I was to show that, the picture will become too big. Everything else will become, very small, hard to see, but it will be shown on the option chain at the right hand side, right? It will show a plus, minus, and some sort of number at the right hand side. So let's say maybe plus minus 10. So it's telling you that the range is plus minus 10 from where the current price is, right? So let's say, for example, if the current price, as an example, is 170, then the expected range would be from 180 to 160, right? So this is how you do it based on the expected move formula, if you construct your Iron Condor based on that. Now, the other way and a simpler approach would be just using the 16 delta options, right? So all you have to do is just take a look at the delta column on your option chain, and you just look for the 16 delta options, right? So as you can see down here, this is the 16 delta. So we want anything from 16 to 20 deltas, thereabouts. We don't want too small of a delta, because if the delta becomes too small, you won't get that much premium and your risk gets a little bit higher, right? So generally 16 to 20 delta would be good. And the reason why we also want to choose the expected move, again, it ties back to the fact that Iron Condors will profit over the long term because of the statistical edge that the realized move is going to be lesser than the expected move. And again, it has to be roughly around the 45 DTE mark. So from here, as you can see, the theoretical win rate, as depicted by this word down here, you see expected occurrences within range. What it's trying to tell us is that if you choose based on the 16 delta options, it will be roughly a theoretical win rate of 68%. Right, so this is the expected move, expected range win rate. Now, as we already know, if you choose the right DTE, the realized move is actually smaller than expected move, which means to say your win rate will actually be higher in actual trading, right? So as you can see down here, this shows you what is the actual occurrences. So as you can see down here, it says actual occurrences within this expected move. So if you were to see based on expected move formula, it says 85%, and based on 16 delta is 71%. So both of them, as you can see, is higher than the theoretical win rate, and that is why we actually have an edge over the long term. Now, one thing I just want to point out is that this number, 71% and 85%, should actually be swapped. And the reason is because the expected move formula depicted by the number on the top right hand side of your option chain it's actually a smaller range than the 16 delta options, right? Most of the time, if you were to go to your option chain and then you were to just, compare both of the ranges, right? If you were to compare the range of the expected move based on this number down here, maybe the range will be somewhere like this, right? So from here to here, this will be the range. And if you were to compare it with the 16 delta options, you will see that the 16 delta options most of the time is actually much bigger than the expected range calculation based on this number. So that is why this number should actually be swapped, right? So that is why the 16 delta options actually give you a higher win rate than you actually theoretically should be having. Next, step number 5, once you have already identified your short leg strike prices, the next one to do is to identify your wings, right? Where you're going to buy the put and the call to have these wings for your iron condor. So the way you want to do it is based on the risk that you actually plan to risk for the trade. So let's say, for example, your risk per trade is $500, right? That means to say you want to construct an iron condor where the most you can lose is $500. You don't want anything that exceeds that. So the first step you want to do to create your iron condor wings would be to just go with the width that corresponds to your max risk. So as you can see down here, your max risk is $500. So you just go with a $5 width on both sides, right? You construct a $5 width on your call spread side and a $5 width on your put side. This is a way to just get started, just to put your iron condor strikes on the option chain, and then from there we will adjust, right? So let's say, for example, you put on this iron condor with a $5 wide. So by the way, you have already chosen the delta. Let's say maybe you have chosen the 18 delta for the short call and also the 18 delta for the short put side. So we've already got these short strikes figured out. The next is our long wings, right? The wings will be the +1 call and the +1 put. So we want it to be $5 away from where the short strikes are. So let's say, for example, if the short strike on the call side, let's say is $180. So this is where you want to take $5, add on to this. So your wings will be $185. And let's say on the bottom side, let's say, for example, it's $160 for your short put strike, then you want to take $5 away. So this will be at $155. So this is how you construct your initial iron condor trade. So once you have constructed this, you should be able to get the premium. So let's say, for example, the premium is $1.25. That means you're going to receive $125 for every one contract of the iron condor that you put on. Now, how do you calculate what is the max risk? So generally on the platform, it should already tell you what is the max risk, right? But if you want to know exactly how it's calculated, it's actually pretty simple, right? First of all, you just take the maximum width of the wings. So as you can see down here, it's $5. So you just take $5 minus off the premium and you get $3.75. So this is your maximum loss that you can lose on this trade. So again, based on one contract of the iron condor, it's $375 per contract. So at this point of time, you already constructed your iron condor and you notice that, you still have some room to increase the risk of your trade, right? Because the max risk you have already decided is $500, but this construct gives you a max risk of $375. So you want to try and increase this. So at the same time, you can also get slightly more premium. So how do you actually increase this risk down here? So the way you want to do it is just by simply adjusting your long strike prices, right? So previously you were at $5, so you want to just increase it by another dollar or another strike price, and you just see, right, from here, what is the kind of maximum risk here. So let's say, for example, you've increased to $6 wide on both sides. Again, it's very important that for you as a beginner to trading iron condors, you want to trade iron condors with even wings on both sides first. Once you get a little bit more experience, then you can go for a skewed iron condor, whereby, one side might be bigger than the other. But at the start, just keep them the same, right? So let's say we keep it to $6 width on both sides. So this is where you start to calculate what is the max risk again, right? So again, you should see that your premium would have increased. So in this case, it has increased to $1.50. So this is how you calculate your max risk on the trade again. You take the width of the wings. So as you can see, it's $6 minus $1.50. It becomes $4.50, which is $450 per contract. So as you can see down here, you pretty much hit, very close to 500. And I will say this is more than good enough for you to put on this trade. Now, step number 6, once you have already gotten this iron condor structure out, this is where you want to start to send this order in and get executed on this trade. So the way you want to do it is by placing a limit order, right? You always want to place a limit order on your Iron Condor so that you can control the price at which you get in, right? You can control the premium which you get. So as you can see over here, this is the Tasty Trade platform. The Tasty Trade platform will show you what is the credit that you want to get that you place for the Iron Condor. So let's say, for example, it's at $1.38. Now you notice below there is this range down here. On the left hand side, it says net, NAT, which is the natural. What it means is that this is the natural price that you will immediately get filled at if you put it at that price, right? As you can see, it's $1.32. And in the middle it says mid, so this is the median price at $1.36. And on the right hand side it gives you the other end of the price, which is at $1.41. So generally when we put on the limit order, we want to try and get as good of a price as we can, as good as a feel as we can, because first of all, we already know for sure we can get filled at $1.32, but we might want to get slightly more credit, right? Because every cent equals to $1 in premium that you receive. So if you see that the mid is $1.36, what I generally like to do is just to increase it by a couple of cents, right, to the right hand side, to just get slightly more premium than what the middle price is indicating. So in this case, I will just put $1.38 in and then just see whether I can get filled, right? Sometimes you could get filled, sometimes you won't get filled. Also, don't forget that the market is always moving up and down. So as the market is moving, this median price will keep changing as well, right? So it might actually move, the median price might actually move up to become 138 and you could get filled then, or on the other hand it could move down as well. So it keeps moving, it keeps changing. This is one thing you have to keep in mind. So let's say, for example, you put in at $1.38 and you notice that you're not filled and you do want to get filled, right? So your prerogative is that you want to get filled on the trade rather than just get the kind of premium that you're just waiting for, and you're willing to let go of the trade if you don't get the premium, right? That's another way you can do it. But let's say you want to get filled, then this is where you want to inch down your price, your limit order, slowly downwards until you're able to find the fill price, right? So basically this is what you call price discovery, where you just adjust your limit price order a bit by a bit each time to see whether you get filled. So for example, what I'll do is I'll put it at $1.38 and I'll just wait for a few seconds, right? Maybe 30 seconds or something like that. And if I do not get filled, what I'll do is I'll adjust it again, right? I'll adjust it down now to $1.36 and see whether I get filled. Now, let's say, for example, at $1.36, I don't get filled and I really do want to get filled, then I will adjust it again. I will move it down, $1.34. So at this time, you notice that the mid price has shifted down, right? The mid price has shifted down from $1.36 to $1.35, which means to say it becomes a little bit harder for me to get filled at the price which I want. So again, I will try and adjust it until finally I get filled. All right, so this is the way that you want to do it as well. You want to use the price discovery method at the start, where you inch it down rather than you immediately get the natural price, because the natural price most of the time would be the worst price that you can get. Now finally, step 7. Now step 7, this is where you want to plan your exit scenarios, and in my opinion this is the most important step, because you need to know what to do once you've already got your trade in, right? Many times you'll be surprised that I get people emailing me showing me their positions, and most of the time these positions are losing a lot of money, right? They are deep in the money and they're going to ask me, Davis, how can I salvage this position? So my take is that if you can put yourself in a position where you have to ask me, then you shouldn't be in the trade in the first place, because you should already know upfront beforehand when you're going to get out of the trade, right? So I'm going to give you a few different ways that you can get out of the trade. So the way you want to exit the trade would either, first of all, be based on a fixed take profit price. So let's say, for example, 50% winner. So as you can see down here, this is done by the Tasty Trade team, where they compared 3 different exit points, right? You can exit at expiration, exit at 50% winner, and exit at 21 DTE. So 21 DTE just means there's 21 days left to expiration, not 21 days in a trade, right? Just to make it clear. So for example, if you put on the trade at 51 DTE, you have to wait 30 days before it becomes 21 DTE. Okay, so based on this table down here, as you can see, exiting at 50% winner and exiting when it's at 21 DTE will have a better performance than if you were to exit at expiration. So you want to choose either one of these two or a combination of both of them. So the 50% winner has a higher win rate, mainly because whenever it reaches 50%, you quickly take the profit off, right? And that can happen quite often. Whereas on 21 DTE, you have a slightly lower win rate because even though it has already reached 50% take profit, you might still just hold on to the trade, and that trade could possibly still turn out to be a loser when you could have taken off at 50% take profit. But at the end of the day, you notice what's important is this daily P&L, right? Which means to say this is the average P&L that you get on a daily basis. And you can see based on 21 DTE, you actually get a higher P&L. And the reason is because at 21 DTE, you could actually make maybe 80% of the premium that you receive, or maybe 90% of the premium received, right? So you average it all out, you tend to get a slightly higher P&L than the 50% winner. So which is better? I would say that there is not one that is better because both have the pros and cons. So as you can see down here, based on 50% winner, the pros is that you have a high win rate, which means to say you're going to experience more winners. So if you're the kind of person that likes to keep winning, then you might choose for the 50% winner, take profit. And the cons is that you have no loss control. So no loss control means that if you do not hit the 50% winner, you might just leave it all the way to expiration, which could be the max loss. Now, whereas for 21 DTE, the pros is that you have a lower volatility because when you cut off the trade at 21 DTE, you very rarely, very seldom actually hit the max loss on the trade, right? In fact, most of the time you won't hit the max loss because you're cutting it off well before it reaches that point, right? The cons is that the P&L is pretty random because you won't know where the P&L is going to be at 21 DTE. So the other alternative would be to do a combo, right? The combo, which means to say you do both the 50% take profit or the 21 DTE, whichever comes first, right? So if it doesn't get to the 50% take profit point before 21 DTE, at 21 DTE, you want to just exit the trade, right? Even though it's a loss. So one thing to really understand about trading iron condors is that this is not one of those 99% or 100% win rate where everybody is talking about, right? Iron condor, you will win most of the time, but there are still times you're going to lose. So this is very important to understand. So as you can see down here, this is again another study done by the Tasty Trade team. And you can see down here, this is based on the 20 Delta $10 white iron condor. So the way they conducted this study is by simply putting it on, and whenever it reached expiration, they put on another one. And for the 21 DTE, whenever it reaches 21 DTE, they close it and then they put it on again. So for both of these two trades, right, the exit at expiration, exit at 21 DTE, both are actually profitable over the long term. As you can see, the study is somewhere from 2007 all the way to maybe past 2017, maybe 2018. But the thing is that you can see that 21 DTE has the much more superior performance because from 2011 onwards, all the way to, you know, wherever the study stopped, somewhere around 2018, you can see that if you hold all the way to expiration, you actually have, you know, a pretty bad performance. Whereas the one at 21 DTE, you still keep profiting and the graph just keeps going up, right? So either 21 DTE or 50% take profit or a combination of both would be good here. So one thing I want you to look at is also that you notice that this graph, there are times where it comes down, right? Over here. So these are points where there will be strings of losses, and this is where you're going to get, you know, losing trades. As again, I told you before in many of my other videos that iron condor, if you place it on the expected move range, is roughly around 65% win rate, right? Which means to say there's also a chance that 35% of the time you're going to lose it. So you do not want to force it whereby every single trade is going to winner. You just want to play it out. So as you can see, based on these studies, they made it very objective. They just let the statistic play out, right? Put it on the trade based on the mechanics. At 21 DTE, they exit it, and they just keep doing this, repeat and rinsing this over time. And as you can see, as long as you keep doing this, even though they are losers over the long term, you can still be profitable. Alright guys, so this is the 7-step iron condor trading plan, and if you like this video, I'll greatly appreciate it if you give me a thumbs up.
By the way, if you like this video, then you're absolutely going to love this next video which I have for you, so go ahead and watch that video right now. Also, if you haven't already gotten your free copy of the Options Income Blueprint, you can do so just by clicking this link down here on your screen, and you'll be able to get it for free. Alright, I will see you in the next video.